my biggest addition has been PGMs. The more things that go wrong, the higher your payoff will be. I still keep coming back to uranium. The whole energy complex is just so hated at the moment.
Well, how's it going, everybody? Thank you for tuning in to Energy Transition Talks. I hope you're having a great week. And if you aren't, I'm going to try and make it better because I've got a great lineup here for you today. Kicking it off with no one less but Fergus Cullen, aka Trader Ferg, aka the Kiwi Kingpin of kilowatts, aka New Zealand's renewable renegade, aka anything else they could think of that is actually funny, unlike my jokes. And then right after Ferg, I've got Global Atomic, an aspiring uranium producer who owns the highest grade uranium deposit in Africa. And there's quite a few tough questions that we need to go through there, given the whole situation in Niger. And then right after it, I'll be going to the Yukon and Colorado to look for many minerals ranging from copper and gold and silver to platinum, palladium, and even zinc, with metallic minerals creatively called so. But before any of that, Ferg, it's been too long since we last caught up. So I'm thankful for your presence, of course, and looking forward to hearing about what's new with you, how the portfolio is doing, what changes you might have made, what are you up to, what's the new breakdown? Talk to me.
Thank you for having me back on to start with. I've seen how your show's growing. It's great. Like, I think between your show and I think it's Money of Mine, whenever they pop up, just instantly click now. Yeah,
Thank you.
The quality of the show. So yeah, starters, just get that out of the way. And yeah, for me, just seen lots of exciting stuff. Some of the portfolio doesn't really agree with me. It's getting kicked in the nuts repeatedly every day, but feeling like good about the long-term outlook for a lot of this stuff. So did you say you want to start with sort of a breakdown?
Sure, we can do that. Yeah, I was just kind of wondering what's new, what have you added, what have you removed? And yeah, I mean, if we can do kind of a percentage breakdown, that's also helpful, of course.
Sure. So what have I added? What have I removed? So probably my biggest addition has been PGMs, and I've got kind of a monster of a post coming out where I'm adding to that a lot, and I just find that fascinating. But a whole sort of thesis around that I can dig into. One I've removed would have been, so I got out of all my tankers and shipping. I just that was just straight valuations. I had bought a whole lot of product tankers and a few other names that kind of like the outlook, like with the Russian invasion, thought there was kind of an angle there, and now they've all kind of traded up or close to NAV. And I was looking at some stuff that was an absolute fraction of that cost. The cheapest was like 15% of NAV, and I was like, I think this is just a straight arbitrage, and that was kind of some little Singaporean shipbuilders, OSVs, just like I kind of called it in a post. It was like going to the back of the sort of shipbuilding queue. I just wanted to get the most hated stuff, the stuff that will have real difficulty being built in the future. Like if you have limited shipyard capacity with a lot of so the whole industry is it's kind of been cut in half from its peak in 2013, 14. And when I see a lot of these vessels needing to be replaced, I just want to know who's going to be in demand, but really is going to have to wait right at the back of the line to be replaced. And so by default, they're going to probably have the highest earnings until, like a prime example is like a drill ship. Like everyone went bankrupt building them last time, had them stuck on their books, and they're difficult to build. Like you're looking north of $1 billion, and the specialists in it are going to be busy building other stuff. They don't really want to go back there, so you're going to have to pay far larger. Like a down payment used to be 10%, they're probably up 40-50% now, and 5 years before it comes online. So you're probably going to enjoy outsized returns for that period. And I just kind of apply that across like a whole lot of sectors. Just see it's again this whole idea of just looking what's hated and where a market narrative is wrong, and that's where I'm finding PGMs just fascinating at the moment, because I just think the narrative around them is completely wrong, and it's setting up some really interesting opportunities when you go down the rabbit hole. But for proportions of portfolio, still very heavy uranium. That's probably up around the still around the 60-ish%. And with that, I just think that's a sitter in that waiting for the Western utilities to come to the table. If there has to be sort of replacement rate or above replacement rate. And if we look at last year, it was just Ukrainian, Chinese utilities. Like the people keep talking about, like I've got this meme that I want to use when I write a post on nuclear that I'm trying to get to, like talking about it like a Mexican standoff. And I don't know if you've seen Dr. No with James Bond.
Yeah.
And there's this scene where the professor breaks into Bond's apartment, and the professor like shoots at him in the bed, but it's just a pillow, and then Bond's sitting there having played solitaire all night, and just sitting there with a silenced pistol, and the professor jumps and grabs his gun and points it at Bond, and Bond's just quietly like, that's a Smith & Wesson, and you've had your six, and then shoots him. It's like, that's the scenario for me between like miners and the utilities. Like, they're out of bullets. They've worked through every inventory. Like, you can look at commercial inventories, you look at inventories around the world. Like, there's nothing, there's no levers left for them to pull. At some point, they're going to have to go to the miners, producers, and if you go down the rabbit hole of that, obviously a lot of it's now going to China. If you look at what the Kazakhs have recently done, and I think the miners are in the driving seat, and you're going to see the spot and term really start to move, and the market take notice as they'll push up through replacement rate. Like last cycle was up around 130%, and I think you're going to have years of that, and you're going to have the new floor and contracts be north of 100, and then you're going to have where the actual ceilings are put in are going to be significantly higher. If you take what they are at the moment, what is it, like sort of 80, and then the ceilings around, was it 120, 130? You can do that math if it gets up to sort of 110, 120, and then I think everyone's gonna latch onto the companies and the narrative, then realizing that just if you do the numbers with what's coming on, we're about a quarter short for projects. And I think this is all coming down the pipeline. So I'm going to be scaling out into that event. And uranium's the next one that I'll be exiting. I like all the rest of my stuff for the longer run. Granted, I got into uranium first, so I'm sitting on the biggest returns there. So 60% uranium, followed by the next largest chunk would be offshore, which probably at the moment it's about probably 20-ish%. Granted, it's a lot less than it was with some of the recent performance getting good kick in the nuts with the likes of Valaris and Tidewater. Some of them, I think Valaris 80 down to, I think when I last looked, it's now ticked into the 40s, high 40s. So that's painful. Same with Tidewater from 110 to down to the 60s. But as I kind of talked about before, the outlook for those hasn't changed. I love those companies, and I think if you go to this whole thesis around moats and cannibals, I reckon those are going to be some of the scarcest, hardest to replace assets that are going to be valued the highest moving forward. And I just think this is a buying opportunity. And just got to have a longer term focus. That's why I've been kind of working through my portfolio, saying where will this be in 5 years, and kind of try not to get too caught up in how negative kind of the view is around energy right now. But pretty sure and know where all this is going, especially when you look at just the whole inflation outlook. Definitely in the camp that we're going to have another big wave of inflation. It's inevitable. Sure. Timing, not so sure. Every time I've tried to guess timing, I've been hopelessly wrong. So I don't try not to do that anymore. Learn my lesson with uranium. But the thesis remains intact. Just got to be able to stay at the table. Back to percentages. Also got coal. That's probably the next biggest chunk. That's probably what, sort of 15-ish, I guess. That's mix of met and thermal. Love those guys. I've just written 2 really long posts on them, and I just think that's talking of like narratives that we're sort of going to wind and solar. You only have to look at what India and China are doing. They're just both adding at least a quarter to their nuclear fleets by the early 2030s, and so I'm just happy to be long that. There's been essentially no capex spent, even likes of Indonesia, which I thought were all about coal. They've even been cutting their capex, and some of their companies are trying to go green, which is crazy. So that's one where I love how much the reality is diverging from the narrative that we're kind of spun by the likes of IEA. And then, yeah, the remains now would be tin and PGMs. Granted, within that offshore, I would have lumped in shipbuilders as well. Would have been in that section. And then, yeah, so tin, still like that. That's I think that's going to be in a quiet bull market. No one's really going to pay attention to it. It's supply stories. The supply is not getting fixed, and you've really only got 2 names to choose from, and both of them are doing good things, really. Metals X is currently in the process of trying to buy the other half, Renson, through the back door. So that's interesting if they get that across the line. But yeah, no, I like both of them. And then onto PGMs, which is where a lot of my focus has been lately. And I think that's probably the most hated sector. That's the most misunderstood at the moment. And the further I've gone down that rabbit hole, the more convincing I find the thesis.
Loads to touch upon there. I want to talk about valuations and how you do that later on in the conversation as well, because that's not as easy when it comes down to the miners. I also know you've found a way to get exposure to PGMs without necessarily going long the miners, if I understand it. So that's something I want to talk about as well. But you make such a good point on predicting timing and direction is it's almost like predicting my wife's moods. You could be right on direction or on timing, but rarely can you be right on both at the same time. And if you could only keep one of those things in your portfolio though right now, but you had to put your entire portfolio in that one thing, meta or non-meta, whatever it might be, what would you do? What do you go long right now with your entire portfolio?
Oh, geez, that's hard. Yeah, no, that's a tough one, because I've always found whatever I have the highest conviction doesn't usually turn out how I saw it. And one of the things that I thought would underperform is usually the best performer. So that's with that said, I think probably the best risk reward right here is probably something like Valaris. Yeah, honestly, like the amount it's been beaten up versus the outlook, I'd say that that or Tidewater for safety as well. Like I think there's stuff that has a bigger, probably between those two and the likes of a Seatrim, like a shipbuilder, that's got a massive backlog that was already hated. So with Valaris, the absolute beating it's got, I think it's got back into sort of hated territory. So those you're so asset heavy. You have had so many write downs. Like if you go through the offshore driller space, like it was just bankruptcy after bankruptcy. And then when they came out the back end, they all kind of started acquiring each other. And so kind of call it subsidized asymmetry. So you've got these highly cyclical businesses that massively overspent in the last cycle, used a whole lot of debt to acquire a whole lot of really expensive equipment, and then just wrote it all off at the bottom of the cycle. And then once they acquire each other again and kind of consolidate, like there's even a rumor going around now, I don't know how true it is, between Seadrill and Transocean. But like the when you look forward, the difficulty that a competitor would even have competing with these guys when they can't, like I touched on it before, you can't build a drill ship. So how do you compete with someone that's got an absolute fleet of these things that they're carrying on their books, having written off all the debt? It's just, yeah. And hopefully they show a little more discipline this time around, because they're talking about buybacks. So they, granted, of course, they're cyclical companies, they'll screw it up and overorder, but there'll be a period in which they're just buying back their stock. And like the poster child of that was AMR, which when you've got strong cash flows and you can just corner your share count, you have outstanding performance on the back of that. So yeah, I think those are probably the biggest sitters at the moment. Yeah, granted, I like the angle I've got at the moment, which is with physical rhodium. Yeah, so that's, I find that quite compelling as well. But yeah, I can go into that as well.
And you're proving that literally no one, you're proving that you go into these things that literally no one is paying attention to. And that's what I like about it. And it actually sets the stage very nicely, because I saw that you've got a piece coming up on an opportunity presented by what you call new energy vehicles. And you talked about it in that post. Oh, it's on traderferg.substack.com, by the way, for people listening. Yeah, but so Ferg, you're talking about how important it is to be on the lookout for when narratives are being adjusted, essentially. Like nobody out there, well, nobody sane out there is anymore talking about 100% renewables anymore, right? It's, what is it? It's zero carbon now. It's what it's going, and so including nuclear in the mix, of course. And I, opening the door for carbon capture, which I still haven't wrapped my head around completely. But I think that the narrative will keep shifting there to beyond that, maybe to low carbon or half carbon, or I believe that's a narrative that is consistently switching. But so you've noticed a new narrative switch here. Let's talk about that. What are you seeing? What's that new narrative?
Yeah, so that's the title of my new piece. So it's just observing the new narrative, or narrative shift, or pivot, whatever you want to call it, to new energy vehicles. And this is purely the observation, as you just made, that there was a shift when there was a realization that we weren't going to hit 100% renewables. You can't run the world on 100% wind and solar. So they had to shift to zero carbon, to quietly shoo nuclear and carbon capture in the back door. And and in that, you also set up you understand that a lot of big capital has probably been invested, and CapEx have been invested on the previous narrative. And so the question you got to ask yourself is, what was underinvested that now will be encompassed in the new narrative? And that's what I've essentially done with the shift from, if you want to call it, zero emission vehicles or battery BEVs, or there's all the different acronyms for essentially just straight electric vehicles, like the likes of Tesla. And what I'm talking about is there's now a narrative shift to the plug-in hybrids. And I think this has got far more legs than anyone's given it credit for. If you look at all in the forecasts from the likes of the IEA, even the platinum miners, they still only forecast the demand will last a few years before it rolls over and electric vehicles take over. And I don't think that's going to be the case for a number of reasons. First being the fact that EVs are too energy intensive, too mineral intensive. And I think if we go into a high inflation scenario, the economics are really going to fall apart. And we haven't even needed to wait for that. You've already kind of seen the economics fall apart if you read all the Western auto manufacturers sort of commentary. They're already, I just put a quote in before, that was Ford's EV division was saying, we'll consider EVs again when they're profitable. It's see inflation coming, that's not changing anytime soon. And so what I have noticed is that the plug-in hybrids are rapidly gaining market share, and so much so that I think they're going to be completely overtake straight electric vehicles, zero emission vehicles, whatever, BEVs, whatever you want to call them. And they're going to do it quite quickly. And you can see this in the data if you look through. And the one that I highlighted in Ferg's finds that you should really be paying attention to is BYD. And this, if you bring up their latest production sales report, the September one, they're already at 57% plug-in hybrids compared to straight electric. And that's been accelerating rapidly. And what you need to understand with essentially the whole kind of ecosystem in China is when people like throw around the numbers that they subsidize. What China kicked off was essentially like a Hunger Games in the EV sector, and they gave them all the food and the tools and the weapons all in the middle, which was either like access to cheap loans, access to state-backed orders from all the state entities to help prop them up. But there was a lot of competition. So I think the Chinese sector started with, I believe it was like over 200 EV companies, and now it's down just over 100. And by the time it's done, I think it'll only be a handful. But the winners will be so mean, lean, and efficient because they're also phasing out the subsidies, which no one talks about as well. Everyone sort of compares it to Western auto manufacturers say, oh, look at the Chinese model, just means we need to subsidize more. Well, it's a completely different model. If anything, it's kind of like pure capitalism, which is kind of crazy because it's coming from the Chinese compared to the Western model of wrapping in cotton wool and pretending there won't be a cost for the sort of the net zero policies, which, like reading an article yesterday, I don't know if you saw, VW is now closing 3 factories in Germany and laying off thousands and thousands of people. And you read those articles, some mention it, but some try and skirt around it, that it's a direct effect of higher energy costs. Their competitive edge was cheap energy from Russia. And the fact that we can't have an honest conversation about it means it's probably going to get a lot worse. And so with the view that BYD's essentially won the Hunger Games, it is rapidly going to be taking over market share in global auto sales. And everyone will say, oh, but EU's tariffing them, US is tariffing them. That's not where the growth is. The growth is going to come from the rest of the world. That's, if you look at the growth trends within auto vehicles, it's all going to be in the rest of the world. It's going to be selling the first car to someone in Brazil and Indonesia and Mexico. And when you start to understand this, you think, well, what's priced wrong? And there's 2 things that were really priced wrong. One's lithium. Lithium was completely priced wrong because it was priced on a future in which every car would require a big lithium battery, and lithium batteries would be the ultimate winner. Or a plug-in hybrid only requires 1/3 the size of battery. And the Chinese have now proved that they've pretty much got 3 technologies to choose from, whichever is the cheapest. They can choose from lithium ion, they can choose from LFP, and they can choose from sodium ion. At the moment, the sodium ion is, depending whose data you use, just like half the cost of lithium ion. And between LFP and lithium ion, it's about a quarter cheaper. And so it's all the capex that's poured into bringing lithium online. I think they're going to have such a rough time because there's all this about ability to substitute if the price of lithium rises too much, and there's that much less demand with the plug-in hybrids being the ones that scale and take over market share. And so where my thinking was like, okay, well, where's there been a big mistake about forecasting what the needs will be out in the future? Because if all things are equal, if demand holds up and you haven't invested in anything in capex, and you're going to have the biggest price response, and you're going to obviously make the most money if you do it in a smart way. And that's what led me to PGMs, and went right down the rabbit hole there, and just been learning a ton about the whole industry, really, and keep finding it more and more interesting. Probably the most interesting facts that I've got coming up in my current piece are just the amount of constraints facing the sector when you realize that the majority of it comes from South Africa. They are having more and more production curtailed on low prices and also on the effective load shedding. So just bigger and bigger power outages. The experts are sort of saying it could be impact of between sort of 10 and even 20% on global supply, just by the fact of load shedding getting worse and worse. And I don't think there's any light at the end of the tunnel when you look at the amount of coal capacity that's coming to its end of its life. Granted, they'll keep extending it, but they aren't doing anything to fix the problem. And then you've just got the overall outlook for South Africa is there hasn't been enough money spent to maintain the sector, and so it rolls over quite heavily from the 2030s on. And South Africa is kind of an anomaly for producing high grades of platinum and rhodium. You do have potential growth in likes of Russia, but that's quite palladium heavy. They don't have as much likes of rhodium and platinum. And so when you forecast this out and you peg it against the demand needs from a plug-in hybrid, which I should have mentioned, the plug-in hybrid requires actually more catalytic converter than even a standard ICE vehicle, because you've got the back and forward between the internal combustion engine switching to the battery and then jumping back and forward. And it's like the highest emission moment is when the engine starts. So as you can imagine, with a sort of a plug-in hybrid, if you take off on the battery and then you're cruising down the road and you suddenly switch on the engine, you're creating more emissions, so you need a higher PGM loading. And there's also some interesting trends I kind of dig into that the Indian and Chinese trucks are requiring higher platinum loadings because of the higher emission regulations that are just keep being stepped up in a lot of the countries. And even this latest trend of LNG trucks, they actually now require, they do require freeway catalysts, so they actually add to PGM demands as well. Not that I'm that sure how much you can extrapolate that trend. And so, yeah, summarizing this all, kind of just keep drilling down and then try and work out what's going to be the most constrained commodity kind of on a longer term outlook.
There's, again, loads to touch upon in there, but it's interesting that in one of your most recent pieces, you talk about this being our fifth attempt at EV adoption. And I say our to mean us humans, although the jury is still out on whether us gingers are actually humans. But what's different this time around is the level of government involvement into these things. Like you said, it seems like the solution to government problems always is more government and more subsidies and all these things, and essentially stuffing very, as you said, inefficient technologies down our throats. And EVs are just one of them. Don't even get me started on solar and wind, or at least not just yet, because I don't want to end up talking about whale psychology here. But couldn't this time around be different again because of that government involvement to a larger extent than before? I mean, if you look at all these 5 times that we've tried to make EVs work, essentially, there was way less government involvement. So where does that come into play?
Yeah, well, that's a good observation, because I've had some people reach out and say, like, never bet against what the government will keep pushing. They'll just mandate it. You often read articles that said, like, this trend is in place, but ultimately it's going to have to fall in line because of this government mandate, or this, like, the government's putting it into law. So it'll have to be done by this date. And the response to that is they can only, my view is this only came around because of this low rate, energy abundant, commodity abundant period. And once you get into a sort of a higher inflation scenario, you have to go back to higher energy density. You can't, and the more they print money to try and make the stuff economic, the less economic it gets. So you're going to get it stuck in your own negative spiral. You can't print something into being efficient, to make sense economically. And that's, yeah, I see them. The more they try and push that, the more it'll people will vote against it, because ultimately, like, the road to ruin, like, you can print your way to ruin, the likes of, like, the Peronistas in Argentina, where you're giving people stuff and they keep voting for you to print stuff to make their sort of life easier, even though it sort of overall leads them to ruin. Whereas printing money to kind of fund a lot of the sort of the net zero roadmap. It's actually making people's lives harder. And when you make people's lives harder, like a lot of the zero emission policy is a luxury. People don't like to say that. That's seen as kind of insensitive because I don't care enough about global warming or the future of children and all that. But I just see it's not efficient, so it won't last. People, when they get hit too hard in their standard of living, they'll pivot back to what works. You only got to look at what Germans, like whenever cost gets too high, they just straight back to coal. And I've always kind of observed the straight hypocrisy with them trying to tell South Africa to close their coal plants and get off coal while they imported a record amount of coal from South Africa during their energy crisis. So it's sort of like do what I say, not what I do. And ultimately, people will not stand for having their standard of living negatively impacted. And this is kind of an observation that goes right back to a lot of ESG policy was just a nice to have. It was like an add-on. If you bought an ESG fund, generally it was stock full of tech stocks, and the whole sort of framework around ESG was just to get rid of energy stocks and emissions. And they've been terrible performers the last sort of coming up a decade now. And so if you loaded your portfolio with tech stocks and got rid of all the energy stocks, then you had amazing outperformance, and that kind of got correlated with the ESG. And now it's only been the last few years that people have had their asses handed to them, being long a whole lot of ESG friendly baskets, and people quickly realizing that people won't choose ESG if it means they have to put up with shitty performance. They'll go with what outperforms, and they'll also pick what allows them to maintain their standard of living, whether that's coal. I kind of see it coming in Europe. If energy costs get too high, there'll be someone that sees the opportunity just to run on they won't call it like a dirty energy policy. They'll call it pro business, pro growth. They'll call it something that allows them to quickly push out a whole lot of fossil fuel energy and bring costs down. And they'll just point at examples like VW closing 3 factories and losing tens of thousands of jobs, and that'll be their running policy. So yeah, people won't put up with it because it's ultimately a luxury. Would be my counter to that, to the fact that it'll keep going on.
PGMs are definitely interesting when you start thinking about it that way, and I obviously haven't thought about them as in depth as you have, because one of the main things when each time I started looking into them was like, okay, but where do you go for exposure? My brain almost immediately goes to miners, but you say you've got a new way of dealing with that. But are miners going to be part of the mix? Is it completely something new? What are you thinking about?
Yeah, so certainly miners are part of the mix. They're quite interesting. There's a ton of value in them, but you just have to put up with African miners, which is I joke I will sleep a lot better when I don't have African miners in the portfolio. I've had enough nasty surprises with the likes of Global Atomic and others where you've done all you think you're onto a winner when you've had your head buried in the quality of the deposit and the quality of the management team, and then all you need is some geopolitical risk to pop up in a coup or in the case of South Africa, sort of a protest, load shedding, change of tax regime, like anything, all of it, nationalization, like you're running the gauntlet of risks. And so the upside's massive, but there's a lot of booby traps along the way. And so that's where I think it's the hardest part of this game is there's always like if you take the new energy vehicles, like kind of like the first level thinking is just go after BYD. If it wins the race, you just buy that. But then enough people already understand that it's already a fantastic performer. If you've only got to look at the latest, like the Seal 6 that for 14,000 USD, it can do 2,100 Ks, and its fuel efficiency is like 2.5 liters per 100. Like there's no car on the market that can compete with that. That's just absurd when you compare it to like Toyota or Ford's latest offering. And then the next level is like, okay, well, who produces the stuff that is underproduced? And then you go into miners, which are inherently terrible businesses. You've got just constant negative surprises, like Sibanye with they just lost another big lawsuit. They've got load shedding. They've literally got an army of private security personnel to try and fight off, incursions by armed groups. And yeah, you're getting involved in that. So you're inherently going to have lots of negative surprises, which doesn't mean you can't own it. It just means there's an upper limit on the position size that I'm willing to stomach. And that's when it gets difficult, when you kind of hit the upper limit on the position size, and then all the rest of your options are also shit. So like I can buy Sibanye and I hit the upper limit on my position size. Do I then go out and buy some Anglo plats? Do I go and buy some Implats? Like it's Impala, sorry, and it's all the same risk profile. I'm just stacking risk profile on top of risk profile. I'm not actually diversifying at all. If South Africa turns to shit, then probably going to get dragged down in any of these companies. And so that's where kind of thinking needs to go to another level of like, how can I maintain the payoff and like really lower the risk? And that's where like smart people like Cuppy, he's with gold, he's like, oh, I don't want the miners. I'm going to find like a sort of a broker type play and go down that road. And with PGMs, yeah, I have looked at JMAT. I haven't bought it and doesn't look that appealing, but you do have those kind of like broker plays where they play more of a middleman, like a sort of a picks and shovels type play. But yeah, my thinking ultimately was like, I just wanted to get at the physical, because then I'm getting the upside and I'm also hedging the risk within the portfolio of the miners. So if you actually can own the physical and things turn to shit, you've actually got a call option on what you were worried about going wrong. And the sort of the more things that go wrong, the higher your payoff will be. And that's before you kind of pile on top the likes of load shedding, the likes of just unrest in South Africa, the likes of the degrading mine deposits, the fact that some of their best mine deposits are degrading the quickest and they're not being replaced. So you can it's not hard to see where they'll have a drop off, and then you just overlay demand from the uptake of hybrids, and yeah, you can come to a pretty bullish outlook, and you can just sit in the middle waiting for it.
You are making a very good point with that quote. The more things go wrong, that's what I just wrote down. The more things go wrong, the higher the payoff is going to be. That's something that I think about a lot. And that's something that we're going to potentially touch upon when we talk about valuations, because it's hard to value these things. Might as well do it right now. I mean, yeah, how do you even value that? Because, and I suppose we can talk about jurisdictions on the back of that as well, because it's the same for jurisdictions. You know, you require a larger discount when it's a more challenging jurisdiction. But that begs the question of, what is a discount to begin with? Is it a discount to NAV? Is it based on a DCF model, which I know you've recently thought of? But how do you value these price-taking cyclical businesses?
You want something where the DCF assumption is it's fucked and it's like literally done. Like
Yeah.
you want a DCF like a coal company where they're assuming if they're pricing it like 2-3 times cash flow, that it's terminal values only a few years out, and you've whereas behind it you've got a mine life of 20, 30 years. Like that's what you want. I'm not sitting down plugging these numbers. I can just see that it's wrong, and that's, I think the more obvious it's wrong, and the more time you spend kind of like this whole PGM trade actually understanding the assumptions that go in. Like, there's nothing more dangerous than a sort of a spreadsheet bandit that just clicks and drags and extends out the assumptions out into the future. Like that's why we're in this mess. If you look at some of the sort of renewable learning rates, it's the fact of how did the likes of the Australian, I'm forgetting the organisation, I think it's CSIRO. It's their Australian sort of Institute for Scientific Research, and they came out with a paper last year that yes, wind and solar are still the cheapest, even including battery and all the sort of integrated costs. And I was like, how the hell did they reach that assumption? And then you go into their model, you bring up their spreadsheets, and all they've done is assumed a learning rate, and they just dial the learning rate up to an amount and then drag it out for the whole life of the asset, so that it's like batteries, they have 7.5% that it gets cheaper every year. And so you can make almost any assumption work on that. It's like going back to sort of asset management days. If someone gives you a DCF and they're like, I want this outcome, you've just got to play around with all your assumptions until you get the result you want. And that's what I feel a lot of these, where it's ending up, is you're just putting in absolutely crazy assumptions. And there's also, I touched on in a post a while ago, if you can't make those assumptions work, then you just have to get rid of some of the material intensity. And so how you do that is you assume a large amount of it's recycled. And so there's, I wrote it down somewhere, there's a avoided impacts approach. That's always been one of my biggest pet peeves when people quote the energy return on investment of the likes of solar and wind, is they just assume everything that can be recycled will be. And so you don't have to include it as energy. So your wind turbine with all the steel and the foundation, all those steel rods are going to get pulled up, they're going to get melted down, and they'll get used for the next turbine. And there's no energy cost to that either. And so anyone with a half functioning brain is like, that's bullshit. And so coming back to how to make this work, just make it as easy as possible with the terminal life on the asset. Is you've got a strong view that it's going to be a lot longer, and then past a few years, all the profits aren't included in the model. And so that's what I'm doing with coal. That's what I'm doing with Platinum Group Metals. They're just assuming battery full electric vehicles take over by sort of 2035. They're assuming that's the minimum half market share is the minimum under someone like IEA. They've got policies where it's pretty much 90%. And so under that scenario, there is absolutely demand's going to fall off a cliff. And why would anyone invest any capex on that outlook? And so they don't sit down and model it. I just know it's wrong. And so it's the whole thing of like, I'll take someone that's got a good explanation on a table napkin over someone with a 10-page Excel document any day.
Yeah, that's something I wrote on Twitter recently, but you're just not very likely to spreadsheet your way into a successful mining investment if you don't understand the business of mining to begin with. It's more, and that's kind of, it hurts for me to say and to think, because I'm an accountant by training. And so it works way easier for me if I could see a couple of numbers on a spreadsheet telling me buy this stock now. But it's there's a lot more qualitative measures than quantitative when you get involved in these hated sectors to begin with. And how do you do that from the perspective of jurisdiction? I mean, geopolitics is increasingly more affecting mining assets, as we just discussed. How do you weigh jurisdictional risk when you pick names to get involved in? Like, let's say you find a company that you really like, cash flows and everything else, and it's a contrarian bet, but it's not in the right place. Do you Like, what kind of a discount do you apply to it? Or like, how do you know when to get involved?
No, well, the start of it is understanding that you're just as likely to have stuff stolen from you in a good jurisdiction as a bad. Sometimes, like some of my biggest hits have been in Australia. Like I with the coal royalties that just got ratcheted up there. I was kind of thinking this is too good to be true, and then just got smacked when they ratcheted up coal royalties. So I got just as bad, not just as bad, but like the likes of Australia to the likes of Nigeria with global atomic. It's yeah, you can get beaten up in both jurisdictions. I think Rick Rule said he's been robbed more times with a pen than with an AK, and kind of always think about that yeah, you've got to be just as careful with a Western government running silly finances, working out a way to kind of steal from fixed assets, as you can be with a sort of an African dictator. And so the way I come at it and have kind of got a whole thesis around it is you want to try and be around picks and shovel type place. You want to be around someone that doesn't have as many fixed assets, which obviously excludes miners, which is why I try and get away from miners, even though I've got somewhat of an addiction and keep finding myself back there quite often. But I like companies. The easiest kind of example of this would be in oil and gas. Like you see like a really attractive producer, but they've got a fixed asset and they're at the whim of that government, what they want to do. They can't move it. Whereas something like a oil services company that's spread out globally, services a whole lot of jurisdictions, that's your risk is spread, and it's harder for that to be targeted, especially if it's like a contractor. So it's more of a derivative of the oil price rather than harder to apply a royalty or a sort of a tax hike on it. And if they do it like the likes of the UK government, just hiking profits, everyone just sends their ships away from it. They're like, oh, that's screwed. Like we'll just transfer their assets elsewhere where it makes economic sense. And so that's something I've tried to apply more, is how to find that sort of angle that's harder to be screwed on, to be robbed. Yeah. And so that's I think trying to apply any level of complexity to like the likelihood of a coup in Africa or like the coal companies I own in New South Wales, will they, if they're running a reckless budget, will they follow Queensland's example and hike tax royalty, coal royalties? Maybe. My only way of really managing that risk is to diversify, hold more US coal companies, and yeah, I can't add any accuracy to the chances of it, so I just have to diversify.
It's really exactly that balance between getting into a country that the market has voted uninvestable while also not having to wait for decades for your contrarian bet to pay off, right? And Rick Rule also always says that he'd rather take jurisdictional risk than he'd take geological risk. But you kind of have to get involved at the right time, right? So some of these jurisdictions that are now challenging, the issues may be resolved in 1 or 2 years, but maybe they go on for 10 years. Are there any specific signals or metrics or something that you found over your career that works, that you can look at in order to figure out when the best timing behind going into a certain jurisdiction is?
No, I'm terrible at it. Yeah, I'd be lying to you if I said I had some amazing. Yeah, looking at my track record, no. I think I learned, but then seem to get smacked around the ears often enough that I'm under no. I think just my position sizing is what kind of saves me. When I see this, I understand that I'm kind of taking embarrassment risk that I know a lot of professionals can't. Like I've had stuff that have gone to essentially zero on me, and it was fine because I understood the risk, and I sized it right. There's I spend a lot of time thinking about what sort of position size can allow me enough upside that it'll make a meaningful impact in the portfolio and isn't too, but I can kind of handle the risk profile. And for me, that kind of generally lands 2-3%. Like if I smack it out of the park and I hit a sort of 10 bagger on a 3% position, that's a really meaningful just added a third to the portfolio. Whereas if you do that on a 1%er, then it's not that meaningful. It doesn't move the needle. And when I get to the 3%, then I usually keep researching the company. And if I get some volatility, then I can try and look to add and take the position up to 5%. And then 5% is usually when I tap out. I don't want to go past that. If I really screw it up, past 5% is probably too painful. And that's generally where I sit. And if I get a 5%er really right, then that really moves the needle. And that's kind of how I've managed my way out. And then I try and have as much diversity across the portfolio as well. Try and have stuff that, granted, I'm trying to lie to myself. I'm lying to myself when I pretend that all my energy names aren't correlated. Like, as I found out recently, so the idea that oil and coal and uranium will all move to a different beat is wishful thinking. Yeah, when you take a hammer in one, they're all cyclical and they're all energy linked. I just see too much value to be in anything else.
So essentially, you would have more than 20 positions at all times. I mean, you rarely would go below 20 positions at one time.
Yeah.
Okay.
No, always above that. Yeah. Always probably sit in the 30s at the minimum. Yeah. I have a lot of kind of 1% positions that I really like to set up. It passes all my screening and I put it on and I kind of want to come back to it. Often the ones that made some of the best calls on are the ones that I kind of started watching and it gets a bit cheaper and keep doing the work on it. And then, it really builds a conviction. And then maybe an opportunity happens where it gets absolutely punished. And I can say that's like a short-term view on it. And I can really build a position there. Yeah.
Wouldn't that have you trimming into strength though? I mean, if you have a 5% position, you get a 10x. I mean, that doesn't happen every day. So optimizing your portfolio for it doesn't make too much sense. But let's say it does happen. You have a 10x. Well, that's a 50% position. You'll go from 5 to 50% or some whatever. It's along that range. It's not exactly 50%. But how do you deal with that? Would you then immediately sell essentially 90% of your position so that it goes back down to 5%? Or how do you deal with that?
No, this is what I've struggled with the most is because I've dealt with this, is that some of my largest positions that I took have also been some of the biggest outperformers, and I had quite a clear way I wanted to exit the sector, and now I'm talking uranium in particular, and that's why I've really let the position size grow, and it's become pretty substantial in the portfolio as I haven't seen any of the signals, like the sort of the utility replacement rates that I wanted to see to start trimming. And that could definitely be viewed as a mistake relative to some of the opportunities I saw along the way that I probably should have trimmed and I should have rebalanced more with some of the objective risk rewards I saw to dial down the volatility a bit, which would have made it a bit easier, and the risk level. So yeah, it's something that I battle with, kind of letting a winner run, which is, for anyone that hasn't read The Art of Execution, it's one of the best books you could possibly read for trading. It's from a fund of fund manager that just managed traders his whole life, and what he observed in the big winners, and they calls them connoisseurs. And that was the idea that they could let a winner run and be very slow to get out of it. But what no one mentions with that is you get absurd volatility in your portfolio. If you have a large position, say a 5% that goes to as you said, if it 10 bags, then that's now half your portfolio. And if that goes up and down, say 20%, that's just put your volatility in your portfolio through the roof. And so that's something very hard to deal with as well, especially if you kind of believe there's a lot more legs in the thesis. So it's something I don't know if I've done it right, but it's definitely hard to deal with, and yeah, something I want to keep improving on.
It's the Art of Execution. I see it's a book by Lee Freeman Shore.
Sure.
Okay.
Yeah. Yeah.
And it says
It's
how the
only
world.
it'll only take yeah, it'll only take you 2-3 hours to read. It's quite short.
Oh, cool, cool. Yeah, because it says how the world's best investors get it wrong and still make millions. And if it's a 2 to 3 hour book, then that's good for me. Probably means I'll finish it in 2 or 3 weeks. Um, what else? Well, last time it's good that we're bringing up exiting strategies because last time we talked about exiting uranium, which you also um, touched upon there for a second at the beginning. But it's interesting how you think about uranium in this case because I mean the consensus, at least in my bubble, is that there's no way of covering the supply shortage, and the data, essentially the supply and demand models that I've seen, all of them, they also suggest the same thing. So it's no longer kind of the perfect contrarian play then in that case where you have the consensus disagreeing, but the data agreeing with you, which is essentially what you want to see. Now you have the consensus agreeing with you. Big tech is going nuclear and all these, what just getting very popular, but the data is also agreeing with you at the same time. So how do you, yeah, how and why do you stay long uranium given that it's no longer the contrarian play?
Yeah, well, this is because I spent so much time. You could say I've probably almost wed myself to the sector with the exit plan, which was I knew what I wanted to see to get out, and probably with some good times that I could have gone into sectors that were a lot more hated. But I still keep coming back to uranium. It's such a unique setup with the demand side being knowable. Like I'm not trying to forecast demand. I know there's these Western utilities out there that have to come to the table. They have to start contracting. And the fact that there just isn't enough, that's what's essentially held me in the sector and held me to see some of my price signals before I really start scaling out. And also, when I look around, anything I would have gone into, I would have probably had the same volatility as well. I would have scaled up the likes of a sort of an offshore driller like Valaris, and that's experienced a decent amount of volatility as well. So I think with this game as well, I did actually have a post that I wrote that was called "What's the Alternative?" and it was this whole idea that, like from John Templeton, that whenever you get into a sector, you want to get into it in pessimism, and then move to skepticism, optimism. The actual quote itself is bull markets are born in pessimism, grow in skepticism, mature in optimism, die in euphoria. And the whole thing, my whole process is when should I be hopping off the train? And I like to always get into sectors in deep pessimism. And where I was getting at that post was like, it's a rough time when you ride it closer to euphoria. You get far bigger drawdowns, you get the retail involved and up and down, and probably make it a lot easier on yourself if you do exit at the first signs of optimism. And I think that's probably a lesson I'm going to take after I exit uranium is I will be quicker to exit sectors on any sign of like optimism. I just think with uranium, it's just done so much work, and I think it's so clear cut how this is going to play out that I've stayed in it longer. Granted, the problem with uranium as well is all the companies are so shit as well. It makes it even worse. Is that you just got dog after dog to choose from. Probably yeah. There would have been a time just to swap it all out for physical uranium, but then a lot of the payoff I think is already gone there. So
Optimism, defining optimism is again qualitative, though it's not quantitative. Like how do you quantify? Like if you have five front page articles, then you sell uranium. That's not something you can do. It's kind of again, feel it with the tip of your fingers type of thing. And I do want to talk about that in a second. But what you said there at the end is also important because it is hard to find good uranium companies out there. And at the beginning, you mentioned the miners. We don't have that many miners in the uranium space. So you're essentially talking about what Cameco, Kazatomprom, CGN, with again challenges with CGN and Kazatomprom being the jurisdiction. So how are you getting exposure to uranium?
Yeah, well, I have a post that's still up on Trader Ferg .com, and I just went after a handful of the mines and care and maintenance that had past history, that had sunk costs, and I've bought them and held them till now, and they've been large multi-baggers. And I don't back myself to be able to pick sort of development projects generally. Obviously, sometimes I've been attracted in and had my ass or been beaten up. They've still done well, but it is hard because just as you say, the thesis is rock solid, but the way to play it's just crap. Even when I look at like the alternatives, like next gen, like they just honestly taking the piss sometimes with how they their costs and how they're going about that asset. And even with the likes I hold like the likes of Paladin, they're getting beaten up because of sort of ballooning costs. But when I look at that, I was like, oh, that's going to be the rest of the guys coming up that are going to have to fix this this supply gap that aren't even aren't anywhere near bringing a mine online. And I just think they're still, the market's not giving nearly enough value to the guys that are in production and can actually produce pounds. Granted, if you go out to 2030, there's like 25% that aren't permitted, aren't there's just going to be this gap, and prices are going to have to really run to get people to actually bring mines on. And where I don't even know how that happens. It's going to be fascinating watching how this all plays out, because there's I don't know if you've seen, it's URG moaning about they can't get any specialized staff. Well, it's going to be the same story across the whole sector. Like everyone's retired, everyone's kind of retired, and there's no experts just to come pop out of the woodwork and show you how to bring the uranium mine on. The same even happened to me with PGMs. Like the expert and the guy that I quote all from my article, I was like, this guy's just fantastic. I'm going to bring him on for an interview. Yeah, he died at the start of the year. He was like in his 70s, and so I was like, all this experience has kind of like moved through and gone. And so I think there's severe under appreciation of how hard it is. You can hear John Borstoff talk about it. Like he's bringing mine on is a tough game, and so I just think it's all been undervalued, and I think they're going to achieve a far higher valuation. Granted, they're probably next in line for me to get out of, but because I got into them so early. But yeah, I want to see that appreciated, and I want to see the price represent like what I think is where supply could actually start coming on. I think my incentive price and my exit plans like around 120. I want to see the utilities at least contract their replacement rate, if not push through it, and then I'll probably start trimming heavily.
That was great right there at the end again, because as I told you, qualitative more than quantitative as to when do you see optimism, when do you start selling. But that is quantitative when you see 120 or and I think when you start seeing the uranium companies start coming out and being more positive operationally, because they're very positive now for the sector when they come out, as they have to be. So Cameco, URG, I interviewed John Cash from URG last week, not yesterday, and he was talking about labor challenges. But so the moment when them and Energy Fusion and everybody else starts coming out and saying like operationally it's all going great, we have a lot of demand for our jobs, or we don't have a high turnover of jobs and stuff like that, that might be a point when you start thinking about scaling out, because it is in large part it's a labor issue. And then you have the utility contracting that you mentioned. That's a good point.
Yeah, I also have just to add to that.
Sure.
With the early signals, that'll be the bulk of like the producers will get trimmed right down, and then I do have a few sort of developers that I will hang on to as the sort of whole thesis progresses, but that'll be an absolute fraction of the size that I'll be sort of carrying in to see those early signals. And when I write sort of the behavioral stuff to get out, like sort of the taxi driver turns around, talks to you, like, have you bought uranium? That'll probably be my last, like, trim my last sort of shitcode junior that I've got 1% in. That'll be, so it's, yeah, it's all sort of on the spectrum of how I get out, like pretty heavy trimming at the start, and then really let stuff run for the behavioral stuff at the end. So it's far more clinical with trimming when those first signs that I mentioned are hit, and then more spaced out with the more junior type plays with the behavioral stuff.
This is great. I think we've been through a lot of topics. We didn't get to call. Maybe we should do a call specific episode sometime soon, because I know you just spoke. You just spoke to the call guys on Twitter, whom I haven't been able to get on an interview. I haven't really gotten an interview. I haven't tried, to be fair. So I should, because call is getting interesting. Has been for a while, but it still remains cheap. Anyways, too many thoughts. I know I've taken too much of your time already. What else am I forgetting? What else is important right now to talk about before we close it off?
Well, you should definitely get Matt and Joe on. They're fantastic. Yeah, I just talked to them 2 weeks ago. So those guys are the studs. They're the two veterans in the industry. So 100% get them on there. They're fantastic. Anything else? You've always got to take signal when everyone's so negative. I think the whole energy complex is just so hated at the moment. You got to remember how essential it is to standard of living and how underinvested the whole thing is. I think we just take it for granted. And I continue to take the other side of anyone that sort of thinks we're in a energy abundant, sort of low inflation world moving forward. I'll just keep stocking my boots with all the stuff that I see doing well in a high inflation, sort of energy scarce, commodity scarce world. I see that's where we'll be sort of 5 years from now. I think all this fairy tale thinking of net zero is going to set us up for a lot of pain until we kind of reset and go back to high energy density with the likes of nuclear and fossil fuels.
And that is why you're the Kiwi kingpin of kilowatts, or the New Zealand's renewable renegade. What did I say at the beginning? I should have written that down. It was actually good. Thank you so much, though, Ferg. It's traderferg.substack.com for people listening, for people watching. It's on your screen right now. If you want to know more about Ferg, if you want to read more from Ferg, head over there. And thanks again, Ferg, for stopping by. Feel free to drop off now, though, as I'll be going all the way over to Niger and then Colorado. But of course, not before my favorite part of every episode, and that is, of course, the disclaimer. So I have a 5-minute disclaimer or something like that, and then we go into the CEO barbecue portion of this episode. There's a warning on your screen right now, as unless you're new here, you know what this is. You're obligated to read it, but you're also better off actually reading it. This is not just your random kind of generic disclaimer. This is an actual warning. This thing, potentially, if you read and understand it, might help you not lose money, which, by the way, is the norm and should be the expectation in this sector. And that is part of it. Money is part of it too. I am here to make money. Okay. My business makes money from the existence of this channel, and specifically from companies paying for the production of these interviews. Now, in this episode specifically, it's only Global Atomic that has paid for the production of their interview. Metallic Minerals is the first time I'm talking to them. And so I'm talking to them out of interest, but potentially they might be paying for future interviews. And so that doesn't mean you should look at this episode any different, because even the companies that are not paying, they're still likely seeing their participation in this program as a chance to do some marketing. So start by understanding that there's inherent bias to that, and you cannot use this as independent research. Start by understanding also that most company communications online, albeit this interview or their presentation or the Twitter accounts and marketing tools, that's all marketing. That is all marketing. And although I don't make buy or sell recommendations because there's a clear conflict of interest, many out there will do that. There's plenty of Twitter accounts that get compensated by companies to talk positively about them, make recommendations on the back of getting paid and stuff like that. So you should be aware of, first of all, you should be aware of that happening. And you should just assume that everyone out there is doing marketing for a company, because that's really how these things work. You should be aware of that inherent bias, because that inherent bias won't always be clearly disclosed out there. So it is safer for you anytime you're watching or consuming any type of company specific content. Whoever mentions a company to you, even if your mom mentions a company to you, maybe your mom's getting paid. Kidding, of course, but just assume everyone out there is getting paid by companies and approach it with a dose of skepticism and treat it as marketing. Unfortunately, I'm not a magician. The guests here are not psychics, and some of the CEOs are even normal people. So we don't possess any superior knowledge about what will go up, what's going to go down, or what's going to go in circles. And also, unfortunately, again, the show is called the CEO Barbecue. It is meant to grill the CEO. That's why barbecue. So I am trying. I'm trying to ask the tough questions. I'm trying to ask the things that literally nobody out there is asking. But I'm not always going to catch all red flags or all challenges with the companies or all shenanigans, whatever else it might be. Okay. I'm not flawless. I don't have enough experience that I could be relied on. So all of this is to say that you should not blindly trust me or anybody out there on the internet, and you should do your own research. And just in general, if you don't understand it, don't do it. There's no need, no FOMO. Don't let the FOMO take you into losing your money. In addition, no guarantees are going to be made here. Besides that, there will be forward-looking statements in these conversations. These are conversations that are general and impersonal in nature, containing hopes for future events that may or may not take place, depending on many different factors, both within and outside of the company's control. Be aware of that. Be aware of the inherent risk to investing and the increased risk of investing in non-revenue generating businesses. And please talk to someone who's proven to know what they're doing and talking about, like a professional investment advisor, as well as do more research before taking any decisions by visiting setterplus.ca, where you'll find the company's official filings. That is a government official website, as far as I understand it. And that's where you do your actual research. YouTube is not research. If you don't do that, you're highly likely to lose your money. There are disclaimers on your screen right now. If you don't enjoy losing money, pause the video, read them, and understand them. And be careful out there. With all that said, though, I'm going to be kicking off the CEO barbecue portion of this energy transition talks by traveling all the way down to Niger, or Niger, if you want to be American about it, since it's been a while that I visited. And of course, I'm not going there alone, as I'll be joined by Mr. Stephen Roman, who's the CEO of Global Atomic Corporation, which is the company that owns the highest grade uranium deposit in Africa, which is expected to come into production by 2026 and continue producing almost up until 2050. So that's 23 years of production, according to the latest DFS, with a total amount of close to 70 million pounds of production over the LOM. That'd be an average of 3 million pounds per year, but that's really only according to the DFS, because there's a lot more uranium on site, and that's something we can talk about later as well. The company also already has 4 offtake agreements with American and European utilities, as well as a plan to finance the build-out of the mine. Although, as we're about to see, that doesn't come without its risks and challenges, and hopefully all things that Mr. Roman and I can touch upon later in a conversation. And I'll actually try and shut up now already and kick off the actual conversation, because Stephen, top of mind is, of course, a couple of things really, but for me, this $40 million financing that you just closed, which was upsized twice. So let's start off with the why behind it, and more specifically, why now? I mean, there were, I suppose, better options. In hindsight, it's 2020, but there were better options 6 months ago to finance at higher prices. So why now? Why that amount of money?
Well, Antonio, good to be with you here today again. And
Sure.
to answer that question, I would say that yes, hindsight definitely is 2020. I guess knowing what we know now, it would have probably have been better to finance back in January, February of this year. We were expecting by March that the banks would have been concluded with everything, and that we would be able to finance at higher levels. And unfortunately, the banks, they're on their own time schedule, and of course, the coup in Niger did not help us with bankers that are very conservative. Their consultants are conservative, and they had to work through issues that they had internally to feel comfortable to move forward. Well, they would give us certain dates that, okay, we'll be done by this date, that date. As I guess the market realizes now that these dates were missed.
Mhm.
And, you know, a lot of people feel that, oh, the banks are going to walk away from the deal. You know, we're in constant communication, and I don't think there was ever any doubt that they were there. I think it's just getting them through the process that took a long time.
Mhm.
So, really, from a financing point of view, we thought, you know, back January, February of this year, we would have had some indication by March from the banks. That would give us a re-rating. We'd be able to cover any remaining equity at that time. And of course, as dates moved, markets changed, the price of the stock changed, and we had to do incremental financings along the way. So right now, of course, since we are in a full construction mode, with a lot of equipment being fabricated by suppliers, we have to pay for this stuff. And unfortunately, we have to raise money and get that done. On the positive note, this is all adding to our equity contribution. And, you know, we can always buy these shares back once we get into production. So I've told shareholders in the past, listen, let's focus on getting DASA built. It is the only greenfield project in the world right now under construction. All eyes are on it. We've had extensive geopolitical issues over the last year that has caused us a number of delays. But bottom line is the project is moving forward. We have many people employed at site and around the world fabricating this plant. And I think that's what people need to focus on right now. So our press release of yesterday obviously gave some additional clarity to what's happening with our debt component. Meanwhile, of course, over the same period of time, we've been working on other potential alternatives, and we've moved those along as well in case banks did not show up. But I think based on, you know, recent conversations, everybody is keen to get this done. We've had a lot of support from our customers as well that are lobbying on our behalf. So, you know, there's a lot of people pulling in the same direction. So I think we have to give the bankers the benefit of the doubt. We know that their heart and mind is in the right place. It's just a matter of getting everything completed to their satisfaction. So I think we're getting close to the finish line, Antonio. So, you know, we have to get the financing done that we did about a week or so ago in order to keep the schedule and keep the momentum. And it's unfortunate that we had to do it at that kind of a price and with those warrants. But I think should things materialize here over the next 3 to 4 months, it's going to be a different story.
Loads to touch upon there. So thank you for that overview. Debt alternatives, we're going to get to all of it and then some. How far, realistically, how far does this raise get you though? Like, when's the next time that you'll be needing more money?
Oh, into next year, into Q1.
Into Q1, covering the entirety of Q1?
No, it won't cover the entirety of Q1.
Okay.
No.
Because I was wondering about some of the prepayments that you might have to make for mine equipment and
Well, you know what?
consumables.
Yeah, no, that's all been done. So a lot of equipment now has been fabricated. It's on the ocean. It's coming to site. So, the majority of the large equipment has already been paid for. The biggest component is our acid plant. That's bought, paid for. It's already starting to arrive in Niger. So, there's a lot of things that we've done and completed up to this point.
Hmm. Well, and that's also something we'll get to maybe in the latter part of the conversation. But you've talked a bit about timing in the last news release as to when you think the bank is going to take a decision. And so you're saying Q1 of next year. And someone
That's right.
online picked up on this actually. So shout out to them. I wouldn't have been able to do it myself. But the DFC here only has a board meeting in December, with the next one not happening until March. So is it what was the idea for them to decide during one of those meetings in December? Are they going to call a special meeting? Are they going to decide at the end of March? Like, when do you think they're actually going to have a decision?
Well, of course, we've never mentioned any banker's name, so somebody's speculating on who it might be.
Hmm.
I don't have any issue with when a meeting will be called, and they've told us they can call a meeting at any time to complete any deal that they're working on. So
Hmm.
I don't know who this is that's telling you this or you're hearing it from, but it's not coming from us.
That is correct. It's as I said, I found it online. But what I'm trying to get to here. Why I asked you first of all, I asked you when do you think you're going to have to finance again, essentially. But so is the idea to not have to finance before you've got a decision from the bank?
That would be the ultimate, to not have to finance until we get the bank decision completed,
Hmm.
because that opens up a whole new area for us. Once the bank debt facility decisions have been made and it's completed, there are a number of other people interested in doing off-takes, potentially also with prepayments, which could handle any remaining equity. So, I think if we can wait until that decision is made and announce that kind of news, then it opens up a whole new area that we can tap for any remaining required funding
Hmm.
without necessarily going back for equity.
Are there new questions that the bank is having, or what are they really asking? Like, why is there no? And I'm sorry if I sound a little bit frustrated, but what else do they need from you? Like,
You're
why are they taking
frustrated? How
longer?
about me?
Why are they taking longer then?
You tell me. These are bureaucrats that typically take a long time. So,
Hmm.
that's the way they operate, unfortunately.
Hmm. What is the new contingencies attached? Is there new questions? Is there
No,
pushback?
no, no, no. I think it's just all relating to geopolitical issues and,
Makes sense.
being comfortable with the space and having this new government in Niger actually pass certain tests, so to speak, that, are they going to be nationalizing assets? Are they going to be doing deals with the Russians or the Chinese or whoever else? I mean, until you have a new government there for a period of time so you can see how they're operating, it's tough for a banker to make a decision on whether they want to lend money there or not.
Hmm.
So, I think they took their time. Unfortunately, we couldn't take our time. We had to keep things rolling. So it necessitated some equity raises.
Yeah. Yeah, and I understand that you would be frustrated, of course, in that case. How confident are you, though, that it will actually get approved this loan? Like, what probability do you assign to it? Kind of, if you had to give me kind of a gut feeling number, if you will.
Well, I don't want to give numbers, but I think the probability is very high.
Hmm. What if the bank is under a different Like, what if the outcome of the elections is such that the U.S. has a new administration?
Well, that I can't comment on one iota because I don't know what will happen.
Do you typically talk to them personally, or is there someone in between to kind of translate
No,
financial to English?
we speak personally.
Okay, good. Well, talk to me about these other alternatives then. In that case, what happens if this falls through? Of course, no one would hope that, but if this falls through, how long do you think it will take you to find alternate financing?
Well, we have a number of JV discussions underway that have been progressing over the year. So we would probably continue with those. And, there's always, as one analyst wrote yesterday, we could just finance the whole thing with equity. So you know what? There's no hard wall that we would hit that would preclude us from getting the project completed. Clearly, having a bank loan that has good payment terms is the best way to go. But it's not the only way to go. So, this project is going to be built one way or the other. It's in high demand. There's a lot of utilities that have already made deals with us, but others that want to make deals with us once we can demonstrate that we have the project financed. So, we just carry on and move it forward.
So your preference for financing it, though, would obviously be kind of in order, if you will. It would be getting the bank approval. If that doesn't work, it's JV. If that doesn't work, it's equity level dilution, essentially. That's how you see it.
That's how I see it.
Okay. What would you want out of a JV? Again, potentially this is speculation, so there's nothing on the table that you can tell me. But what does it look like? Does someone take 50%, 70, 30? I don't know. What does that look like?
Well, you know what? I'd really rather not get into it, but I'll tell you, Antonio, that we want to maintain control. So we definitely have over 50%.
Right. On the topic of timing, then in that case, let's talk about something that you could potentially talk about. If the Benin border stays closed this and next year, do you have an alternative way of getting the materials for the build out? Let's assume everything gets financed, it goes on time. Is there an alternative way to get your materials? And if you do, how much would that slow the build out down?
Well, since the coup, of course, and the Benin border being closed now for over a year, we've had to bring things in through Togo and Burkina Faso and through Nigeria. So right now we've got a lot of big components coming through Nigeria. And it's actually a very good route. Apapa is the name of the port, just near Lagos. And there's a direct route up to a dry port called Kano, Kano, in the north part of Nigeria. So what we do is we bring things up in containers from Apapa to Kano, and then we have Niger trucks coming to Kano to pick it all up and bring it to Dassa. So that route is quite good. I'd say probably better than the Togo Burkina route because Burkina has, of course, been having issues in that country with militants, and everything's got to come via convoy. So we've done that as well, but it takes longer. So what we've done is we've added an additional amount of time into our build process that takes into account the logistics delays.
Is that all on order right now? Is the final engineering and the final orders for the long lead items, if you will, is that completed?
Yes.
Okay.
Yeah.
So what does that look like? What does the delivery schedule look like for those parts? And more specifically, why I care? Obviously, timing. I want to know if you're still on track to actually build this by 2026. But I also want to know how you're going to be paying him off. His capital is sensitive here. So what is it? Is it half upfront? How does that work?
Oh, it's a negotiation on every different item. So some of them you need to put down 10 or 20%. Others, you need to put down more. And you have payment schedules until it's completed, and then you have a holdback. So typically, once it's shipped and up and running, you pay the balance. So it's every item goes through a procurement process, and every item has a contract. So all of that is negotiated.
But you actually pay for them once they're on the boat, essentially, or wherever they are.
By the time they're on the boat, it's pretty much fully paid except for the holdback.
Okay. And then so far you've ordered, you don't have any yet, but you've ordered everything you need to start actually building the mine.
The mine is pretty much built right now, so it's the plant that we're
The plant,
focused
yes,
on
I meant the
right
plant.
now.
I'm sorry, yeah.
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 No, the plant, the major materials have been fabricated. Some of them are almost complete. Others have been completed and are actually on the ocean right now.
Okay, good. That is a good update, actually. How are your conversations with the government going right now? I assume they might have additional questions too, especially given that they've what do they have to finance 20%, I believe, if I'm not mistaken. So how are the new
They finance 10%, so they have a 10% free carry and a 10% participating interest.
yeah. So how's that going? They're still happy to do it. There's no
Yeah. No. The government, I don't know if you've seen a letter we got from the head of state, copy to all his ministers. We initiated that and asked for a support letter. And he wrote a very strong letter saying this is a very strategic project for the country. It's very important. And they're 100% supportive of the project going forward. And he directed all his ministers to help us wherever we need it. So the government is very supportive. We have direct contact with the mines minister and his department on a regular basis. I will be meeting with them all when I go there in 2 weeks. So I do that every time I go. We make a visit, a courtesy call, and go through any issues that we may need to discuss. And of course, since they're a partner of ours, we go through every detail. So then they have now a committee that reviews all of the technical aspects and comes back with their comments.
But you're going there in 2 weeks, you say. It's just, I mean, it's safe for you to go there. You just go there. What is it, without guards, or like, how does that work for you being in the ground?
Well, we fly into Niami. No, we have our own security service that looks after all of us when we're driving around town. And then up at the site, of course, the government has 60 troops stationed there. And that's been, since I've been in Niger 20 years, that's part of the whole government mandate, is to secure the Timber-Soy Basin where all the uranium is found and provide security services for people that are working in the basin. So that's been there since day one.
Yeah. Okay, good. That's interesting to hear how that goes down. Hope we'll see some visuals from your visit there. Where I came from with the question of how are your talks going with the government, Stephen, is because of what's been happening with Orano. I believe there have been some issues where the government had signed, agreements and then didn't want to honor them. And I want to go in details on that specific thing, but is there realistically something you can do about it if that becomes the case on your contract?
Well, I don't know any agreement that the government didn't honor. So Orano had the Imuraran project and GovX had the Matahuela project. Those projects had mining permits issued. And the rule in Niger is if you haven't started mining in 2 years or developing your project, more specifically, then your permit effectively is expired. So they had substantial amount of time. Now, those projects, of course, have totally different economics than our project.
Correct.
So the issue could very well have been, listen, the projects didn't meet an economic threshold due to uranium price, which only started moving up in 2020, 2021. But the government said, well, listen, you've got some extra time. Maybe you can get something going. But then, with nothing really moving forward, the government decided to bring them back into the public purse, and they're available for anyone else that might want to take them on. So it was just really a timing issue. See, we applied for our mining permit and we received it in December of 2020. And in November of 2022, so before the 2 years was up, we had our opening blast ceremony on November 5th. So, we were in the time frame allotted by the permit to move things forward.
Yeah, I believe that the Niger government currently does owe Orano a debt, though, if I'm not mistaken. Yeah, we're not talking about Orano here in this interview, but it's an interesting process to see how that goes down. As far as I understand it, Orano's projects are now up for grabs, essentially. I mean, they're not for grabs, but they're up for sale, or like they're available.
You're talking Imuraran?
Yes.
Yeah, I guess that project is back in the hands of the government, and anybody can bid on it. Urano might even bid on it again. So, it's available.
Might that someone be named Stephen?
No, no. I'm busy with DASA.
That is clear. Do you think the government could do some of these things on their own? And do you think we're going to start seeing that happening more and more? I mean, you hear that a lot in the Sahel region, where the government or governing powers say that they can build their own mines. They don't want Western involvement. Do you think that's realistic to start happening with uranium specifically?
Frankly, I really don't, because the expertise you need for a uranium project is much different than for a gold project. Gold projects, you can start with small deposits. Depending on the grade, you can make money with little deposits. Of course, all the illegal mining activity and shipments of gold have proven that. But with uranium, it's a whole different ballgame. It's a completely different metal. You have to take into account the radiation fact. You got to take the processing into account, and how do you actually produce yellow cake? It's a complete chemical process rather than a simple leaching and carbon absorption that you might have in a gold project, which is pretty straightforward. So, I know in Mali and other places, the government said, well, listen, we're going to kick out Barrick and take over these projects because, we want to make all this money for ourselves. But, other African nations have tried this before. In Zambia, I believe it was, in the old days, in the copper mining industry, the government said, hey, listen, these foreign companies are making too much money and they're taking all our resources. I think we better do it ourselves. And they nationalized all those mines, and they basically cratered all of that production because they didn't have the expertise to do the mining or the processing. So, and that's in copper, which is pretty straightforward and simple as well. Uranium is a whole different ballgame. And, the amount of expertise for uranium is very, very limited. There's not that many people out there that know anything about uranium mining or processing.
That is true. Last week, I interviewed an American uranium producer, UR Energy, and they're having personnel issues. They're having challenges attaining personnel and keeping them on once they find them. Is that going to be an issue for you once you're in production? How many people do you need, and do you think you can get all of them?
Well, you know what? We had a little bit of a break, let's say a positive development for us, in that the Cominac operation shut down over 2 years ago, and there were 700 people laid off. And of course, it's the same type of operation we have. It was a ramp access underground mine with a processing plant producing yellowcake. So currently, we've brought on a lot of people from the Cominac operation. We've also done nationwide recruitment, and we have training programs. But also, the people on standby are the ones that were running the plant. So those people could be available to us as well. And so we once we get the plant further along, we will start bringing in people and integrating them into the SOMITA organization, having them involved with the entire plant build out, because that way they will get familiar with the flow sheet, the operation, and all the components, so that when the plant's ready to turn on, they're fully up to speed.
And that's when do you think that's going to be happening? Is it about a year from now? I suppose Q4 of 20.
No, we'll start bringing in a few key people probably in the next 3 to 4 months.
Okay. Is that going to increase your burn rate in the meantime, though? I suppose it has to.
Well, as you hire more people, you're going to have a higher burn rate. Right now, we have about 450 people working on the project. That'll ramp up to over 800 people during full construction in 2025. And then it'll settle down in the 600 to 700 people range, similar to what Cominac had once we're in full production.
Right. Okay. I also had a couple of DASA-specific questions here while we are in the topic, because we haven't really talked since you published the updated DFS, I believe, which had significantly higher costs in it, as well as, of course, significantly heightened LOM. But how set do you think those all-in sustaining costs are now? And is there a way for you to get them any lower from here on out?
The short answer is yes. The biggest cost we have in the mine is electricity, power. So right now we've included the power costs based on the Niger grid, which is a coal-fired plant in Agadez. That line goes up to the Arlit mines, Somer and Cominac, goes right through our property. So we're going to tie into that grid as our main source of power with diesel backup. So there's a couple of things that we can do there. One is they're still talking about putting a natural gas pipeline in through Nigeria, Niger, and Algeria to ship natural gas to Europe. If that pipeline goes through, we can convert a lot of our backup power to natural gas, which will be much, much less than the diesel. But also, we're studying the idea of upgrading the power plant at Sonichar, which is the local utility, and putting in a modern coal-fired burner, which will be much cleaner and more efficient and significantly reduce our power cost. So that's a big incentive as we continue to move forward. We also may install some solar that could also reduce our costs, and of course, become more efficient by putting more throughput through the plant. So the mine right now is designed at 1,000 tons per day. I mean, that's our initial plant throughput. The facilities of the mine, the portal, the openings, can run at 2,000 tons per day. So as we get familiar with operations and ramp up, we can incrementally increase the throughput which will dramatically lower our cost per pound.
Why did you have to cap it at 1,000, by the way? I saw that in the updated DFS too.
Well, we capped it at 1,000 because as a new producer, we felt, coming in with a huge amount of production was not prudent. I mean, basically, you have to prove that you can operate. You have to prove that you can produce. You have to be able to sell uranium. It's not like gold, where you can take it to the bank and swap it for cash. You have to build your customer base. So the idea was that 1,000 tons per day with the grade we have, we'd produce between 4 and 5 million pounds a year. That's sort of a sweet spot. I would say that's not going to overly affect the market. And it's the amount of uranium we felt as a new producer we could sell. Now, if the demand is there and the uranium market continues the way it's going, of course, we can start bumping up the throughput and producing, perhaps 6 million plus pounds a year. So that, of course, with the same equipment, with a lot of the capex covered by effectively our current design, that'll reduce the cost per pound.
It is going to reduce the cost per pound. And so will the energy thing that you just told me about, but I supposedly it's going to add to your capex, right? The pre-production capex or the expansion capex. How much is that going to add?
Well, right now we're our budget is our budget, so we're just doing what we're supposed to do to build this plant and get things running. But there will be optimization plans as we go forward, and we'll do it out of cash flow. We're not going to do it now.
So nothing is going to change in your pre-production capex. What was in the DFS stays the law, basically.
That's it.
Okay. So no more updated DFSs. You're just going through with this.
That's right.
But as far as I understand, the geotechnical model for DAS is still evolving, though, and I suppose you're still going to have to minimize stope stability risks and so on and so forth as you grow the plant. Could that change anything in the economics?
Well, part of our plan, and it's always been part of our plan, is to do underground definition drilling and, potentially expand the ore body, drill on tighter centers. We may tweak the mine plan a little bit based on information we get from that. But the stope layouts right now are very conservative, and I don't see any major impact aside from getting better resource definition and stope design. But they're all big stopes. It's all long hole mining, very efficient, very low cost, and that's the way it's designed.
It is low cost, but what's the breakdown of that cost? So you said energy is a big part of it. Labor is going to be a big part of it. Safety is going to be a decent part of it because you're dealing with relatively highest grade in Africa. So you got to be, watching out for radiation and whatnot. So yeah, what's kind of that breakdown in terms of percentages on a per pound basis?
Well, I would say probably your energy is in the 25 to 30% range, and your labor would be similar. And then you've got diesel costs, logistics costs, and all of that, right?
Yeah. Sodium carbonate reagents, I suppose, is part of it too.
All your reagents, your sulfur costs. Yes.
Well,
so that all adds up.
So again, you're gonna need a couple of different reagents essentially. How's the supply availability of that? I know we've seen some troubles from an acid perspective in the ISR producers. This is not the same, so not to be mistaken by listeners or whatever. But they, like in Kazakhstan, they've had issues with that. How's the availability of reagents for you?
There's no issue with reagents as far as I can see. Sulfur is available. We have to get it to site, of course, and we have our own acid plant, so we make our own acid. A little different from Kazakhstan that has run out of acid, and they need to increase that acid production. Also, their ore bodies are getting quite old, and their areas that they're planning on mining take a lot more acid. So they're lower grade and they're potentially tighter zones, and they need more acid to get the recoveries. So, we're just going into a new mine here. The flank zone area is a very good grade. It's an excellent place to start mining. Of course, it's close to surface. The ramp's right into it now, and we're already bringing ore to surface.
Yeah, that's a good point, because I think you'll also be stockpiling ore for consistent processing once you're fully ramped up. What do you think is the optimal size of that stockpile in order to manage the cash flows, essentially?
Well, I'll tell you that we don't want to have more than 50,000 tons on surface before the mill starts, because the nature of the ore is high-grade material. You don't want to be bringing it to surface until it's ready to go through the plant. So we'll have, low, medium, and high-grade stockpiles, and we'll blend it to keep a consistent level going through the plant. So yeah, I would say by the end of next year, we'd probably have 50,000 tons sitting on surface.
So by the end of 2025, so that you can,
Yeah.
Do your contractual obligations start again? When do you have to be delivering pounds?
2026.
Okay, 2026. What happens, by the way, with those contracts if you don't? Again, when nobody's hoping for that, but if you didn't, can you go back and renegotiate them? How does that
We
work?
don't need to. There's time limits built in, and if we pass a certain time limit, the utility has an option to walk away.
Okay.
So we don't get charged with any financial penalty.
Right. Okay. No one's hoping for that. Let's hope everything goes as planned in the meantime. What else though? What else happens in the meantime in the next couple of months as you kind of await approval from the bank, from a geological, geotechnical, or whatever kind of work that you have to do something else?
Well, we're now boring our ventilation raises, our big ones. These are 5-meter diameter boreholes. We've just completed one. We're working on the second one now. Once those are completed, we'll install the fans. We've now opened up. We're into the second level, so we want to develop 5 levels underground, but we need to have the ventilation in place before that happens. So this is really the big push to get that ventilation facility completed, and then we continue developing the levels in order to access your stopes.
And that's what's the timeline on that?
I would say that the vents should be done by January, February timeframe.
Okay. All accounted for financially, I assume, with the money that you have right now, you're going to be able to do it?
Yes.
Yeah. Okay. I was going to ask you about infill drilling, but you essentially told me that once you're in production, you're going to be doing infill drilling from within the mine. Essentially, that's what it comes down to.
Well, we're going to start that probably in the next 2 to 3 months.
Okay.
So as levels are opened up, then we'll be setting up drill stations and doing infill drilling. So that's going to be carrying on as of Q1.
How come? Why do you need to do infill drilling right now if you're not going to be doing an updated DFS?
Well, because it's important that you do tight space drilling and know exactly where the ore body is. So for measured and indicated, we do 25-meter centers. Once you're underground, you're probably going to be drilling that in 10 or 15-meter centers. So since some of these areas are very high grade, we want to be really precise on where they're located and how big they are. So, with 25 meters accuracy on the surface drilling, 25 meters is pretty far. Now you want to bring that in so that you can know exactly, if your material is running at north of 1%, you want to make sure you know exactly where it is. And that also affects your ventilation plan and you might want to leave a certain area alone before you access it to make sure your ventilation is ahead of opening up an area that might be that high grade.
Yeah. Listening to you, someone might think that you know what you're doing and that I don't, and I think they'd be right to get to that conclusion. What
Well, I've been in the business a long time.
Yeah, I think so. I was actually just reading a book about the first uranium rush, which was in the 70s, which is where your dad got involved in the uranium space actually. Now,
Actually, it was the 50s.
was
He
it in the
discovered
50s?
the world's largest uranium deposit in 1953
At Elliott
and
Lake?
built the mine and built the town of Elliott Lake, which didn't exist, and started that mine in 1957.
Hmm.
So that was really to supply America with uranium during the Cold War.
Yeah,
That's the way things got kicked off. And then, of course, that expanded into nuclear power utilities.
exactly. There have been on the topic of geopolitics, Stephen, you're reminding me of some of the changes that we've seen in the relationships between Turkey and Niger in this case. You have an asset in Turkey with a zinc asset. Is there anything that could be done there? And again, I would be speculating here, but Turkey has their own development bank that is capable of financing projects of this size. Is that something that might be of consideration?
Absolutely. Yes. And we've been speaking to various levels in Turkey about potentially getting involved in a number of areas, including financing, but also construction. So the Turks have built a new airport in Niamey. They've built a new hotel, the Radisson Hotel there. They do road works in the country. So yeah, then they'd be a good partner.
Hmm. Is it, you say you're talking to them? How serious is that? I mean, are they coming to site? Is there anything else that you can tell me about that relationship there?
Well, we haven't had site visits at the moment, but we've had many discussions.
Right.
And of course, we also visit with the Turkish embassy in Niamey. They have an embassy there and an ambassador there. So they have bid on some of our work. So yeah, no, we have a very good relationship with Turkey.
Hmm. What about that zinc asset that you have a part of there? I know that's kind of a darling for you. I mean, it's made a lot of money for
Well,
you over the years.
yeah, it is a little bit of a darling, but it's something that we created and acquired an old beat up, shut down plant during the financial crisis in 2008 and rehabbed it, put it back into operation. It provides a very valuable service to steel mills in our region by handling their waste and producing some value added product. Obviously, the zinc oxide concentrate.
Hmm.
But that's really what helped us get DASA where it is today, because after Fukushima, an equity market dried up. The zinc asset, which we combined with Global Atomic in 2017, really financed the development of the project with our own cash flow.
Hmm.
So, people said, are you gonna sell that asset? Well, maybe at some point we need to sell it or dividend it out to our shareholders. That would be a preferred route, so they get a benefit of that cash flow going forward. We built a brand new plant in 2019, 2020. Our partner, Befesa Zinc, are the tops in the world. So it's been a very, very good joint venture that we've created there in Turkey.
What do you what's the value of an asset like that? I don't even know where to begin valuing a thing like that, and an ownership like a minority ownership like yours.
Well, you know what? It's based on EBITDA. Typically, Befesa trades, anywhere from 8 to 10 times EBITDA. We might get discounted from that, of course, if we were to sell it to Befesa. But I think we need to get a couple of years behind us with profitable production. Again, we had a bad year last year because earthquakes in Turkey that really shut down most of the steel production. This quarter, we should have a really good quarter because we have a lot of waste to process. And, it would be good to, keep it on board for now and think about it when markets improve for that asset.
That would be
Zinc price, of course, it was up at 160, 170, then it came down to just above $1, and now it's back to 140. So, if zinc price goes back up, then, it might be something we'd consider.
Yeah, that's but that's not like you don't have to work on that asset. You personally are essentially 100% hands off, right? I mean, I suppose you get updates, but it doesn't take away from your focus
No,
or
we
time.
have monthly board meetings,
Okay.
and we get management fees and sales commissions every month. So we're involved with the management there.
Oh, okay. Good. Stephen, I don't want to keep you all day. I know you probably already had to have gone by now, but this is a question I've started asking almost everybody on here. But with your stock is down almost 50% this year. We're going into tax loss selling season. Is there a way for you to manage it? Is there something you can do, insider buying in the open market, something that you can do to manage any potential stock that might come on the market?
That's a good question. I would say that would be difficult for us to do. I think the market is what the market is, and people have to realize this is significantly undervalued. Don't forget, in our last raise, as you mentioned, it was upsized a couple of times because of demand. The demand was very robust from the institutions that all support us, including new institutions, but also the retail side got in a big way into this last financing. So that's something we don't usually see, but there was a big retail component. So you know what? A lot of people are recognizing, we've really been beat up over the last year because of primarily geopolitical issues and financing delays. And maybe rather than selling here at tax loss season, they should be buying more.
You're mentioning your financing, and you're reminding me of the previous financing that you did, which was about half the size of this one, I believe, $20 million range, if I'm not mistaken.
In July.
June, July, August, September. So that's coming free trading soon, during the tax loss season, if I'm not mistaken. And I know you've extended warrants in the past, and you've done other creative things. Is there something you can do to mute the potential effect of that free trading date that's coming up?
Well, you know what? That's same as the question you just asked me. I mean, we are getting to the end of the year here. If there's people that want to sell stock, I guess they're going to do it. We just have to wait and see what happens, and hopefully there'll be more buyers than sellers. And we like to come up with more news, Antonio. So, if we can get some more positive news out here before year end, then that might change the nature of the whole market.
Yeah. You make a good point. As we're going through these things, I'm thinking everyone always asks, where is Stephen Roman? No one asks, how is Stephen Roman, right? So how have you been? How are you holding up, like, personally throughout this entire experience? This must be, I mean, we laugh about it, but come on, this must be stressful, and it's pressure on your system, right?
It is definitely that. I get it from every angle.
So how do you deal with that? Like, I
don't know. I guess I'm just a stubborn mule head, and I keep going.
That's a fair response. I suppose, again, Stephen, we've been through, it was a broad ranging discussion. I've been through, I suppose, all of the questions that I had on here, definitely most of it. What am I forgetting to ask you, though? What's important that you think we should be talking about here at the end?
Well, I think, Antonio, we've got a fantastic project here. The deposit looks tremendous. What we've found going underground looks better than what we expected. I would think that this infill drilling is going to hold a lot of surprises. Don't forget, with the announced DFS mineable reserve we have, We have a lot of additional inferred resources at a very high grade as well that, we need to just keep building this deposit. So it's a real world-class asset, and people need to recognize that and forget the geopolitical issues. Things are moving forward. I think we've proven that the government is on our side and that they want this project to happen. And just buy it and put it away for 6 months. Don't be looking at the market every day.
Hmm.
Uranium prices should continue moving higher as we move into next year. The nuclear renaissance, and I don't like to overuse that term, but it really is. I mean, in all my years, I've never seen anything like it, with everybody now wanting to build reactors, including small modular reactors. This market at some point is going to really take off.
Hmm.
So, now's the time to buy. The idea, buy low, sell high. I mean, we've given everybody a great opportunity here.
Hmm. Are you getting contacted by utility? Because you mentioned we didn't touch upon too much on the uranium market itself, but are you getting contacted by utilities that you don't have contracts with, and they're kind of asking, hey, what's happening? When are you going to be in production? And how's the overall interest or sentiment on the utility buyers side?
It's very good. And we just, in September, we're at the World Nuclear Association symposium in London. So that's an excellent venue to meet all the utilities there. So we met with many utilities. And aside from the ones that we already have deals with, there are a number of others that are very interested in contracting as soon as they see that the financial part of the equation is completed. So I think it's going to really be a fabulous time once we get all this behind us.
What about on the and I promise I'm going to stop here at some point. But what about the smart money, so to call it? We see a lot of smart money going into other sectors of the mining space, gold and so on, in some of the neighboring countries in West Africa, although sub-Sahel, I suppose. But how's the interest in uranium from the smart money perspective, and in your case specifically?
You know what? It's been a little bit slow to get into the space, but I think it's coming in now. You see a lot more discussions with family offices and people, generalists, I would say, that really didn't know much about nuclear or about uranium or about market fundamentals. I think they're slowly getting educated, and they're starting to very quietly come in. I don't think they've made the big push yet to get into this space, but it's definitely happening.
I sure hope you're right on that one, Stephen. I know all uranium investors, we can all use some smart money optimism coming into the space. But thanks again for doing this. I'm actually shutting up now. I promise I'll let you go to do your extra job. I'll let you drop off and hopefully speak soon on the back of that. Hopefully on the back of that financing. And otherwise, we should still have a chat early next year and see what other options you are, what you're up to, how's money, and all these things. But yeah, for now, I'll let you drop off. Thank you so much for being here. In the meantime, I'll be going to the Yukon again, but unfortunately not to watch the Northern Lights. Instead, I'll be looking for high-grade silver deposits, but that's actually not it, because while I'm at it, I'll also be looking for gold, copper, platinum, palladium, and even zinc, which might have me at a certain point jumping down to southwestern Colorado, as well as many places to be. I'm not going to cover all of it, but I'm going to be, luckily, won't be going there alone, as I'll be joined by Scott Petzel, the president of Metallic Minerals, an exploration company listed as MMNGF on the OTCQB in the US and MMG on the TSX Ventures Exchange in Canada, where an average of about 170,000 shares trade each day. I see a 52-week high of 39 cents and a 52-week low of 18 cents. There are 176 million shares outstanding, and with today's $44 million market cap, that means MMG is trading at about 25 cents per share. In addition to the 176 million shares outstanding, there are close to 20 million warrants and 16.5 million options, leaving the number of fully diluted shares at about 212 million. A couple of famous names on the share registry here. Eric Sprott, he owns about 14.5% of the company, actually. Newmont owns a little under 10%, 9.5% to be specific. That's going to become clear here in a second. Institutions as a whole own 22%. In total, that's including US Global OTP funds and MMCap Asset Management. Speaking of management here also owns a chunk of the company, 17% to be specific. And there's 10% in the hands of high net worth individuals and 27% in the hands of retail investors. The last officially filed financial statement on Setter Plus shows me the numbers as of April 30, 2024, and it had $1.6 million in current assets on it, mostly in cash, gold, and due from related parties for the respective amounts of $300,000, $500,000, and $760,000, with, of course, smaller amounts of receivables and prepaid expenses on top of that. Total liabilities at the time sat at just about $150,000, all of which was current liabilities, virtually split in half between account payables and dues from related parties. In terms of operating expenses, the 9-month period that ended on April 30 this year costed Metallic just shy of $1 million, which is a G&A of $105,000 per month on average, to be specific. The largest element of that spend was consulting fees and professional fees, which combined represented about 45% of the total administrative spend. About a third of that, so 32% of the spend, is represented by investor relations and corp dev. Another 15% was spent on office and administration, and the remaining 8% or so is represented by travel costs and a few other smaller expenses. As to the exploration and evaluation costs, they show almost $4 million spent for that period, which is an average of $420,000 per month. And you're going to have to go to note 7 in the financial statement, where you can see the breakdown, which shows me that drilling itself accounted for about 36% of that overall spent. Another 33% was spent on geological consulting. Analysis costed about 10%, with various other smaller costs like helicopter equipment, camp costs, and others making up the rest of the spend. So in summary, $105,000 a month is going into administration, and $420,000 is going into the ground, leaving us with an exploration to administration ratio of about 4-1, meaning about 80% of the money that the company spent went to exploration and evaluation, and a rough 20% went into administration. As always, though, please understand that this financial statement is nothing more than a snapshot in time. In this case, it is specifically at the end of April of this year, and it simply shows you what the finances look like on that exact date and nothing more. Finances, though, are a fluid thing, and math could be hard, especially if you're me, so I could be making mistakes in my reading of them. That's why it's imperative that by the time you're watching or listening to this, you visit the company's website, as well as setterplus.ca, to look at the most up-to-date numbers yourself and make sure you're getting the full picture. For Metallic, that full picture is, again, kind of split between the Yukon and Colorado, where they're looking for copper, silver, gold, platinum, palladium, zinc, and lead in Colorado, and high-grade gold and silver in Keno Hill, as well as the Klondike up in the Yukon, by the way. So I'll start off in Colorado, though, with La Plata, with the La Plata project, which, of course, translates to silver in Spanish. But this is actually a copper, gold, silver project, as it is a precious metals rich porphyry. Now, there already is a resource estimate on this project showing 1.2 billion pounds of copper and 17.6 million ounces of silver in the inferred category. That is at a copper equivalent cutoff grade of 0.25, but the resource runs about 0.4% average copper grade and a 3.7 grams average silver grade. So the cutoff is 0.25 copper equivalent, but the average is 0.4% copper equivalent, for a 1.3 billion pounds of equivalent copper, again, most of which actually copper. Now, this MRE is from 2023. That actually rhymes now that I'm thinking about it, which is kind of cool. But what else is cool is that Metallic is planning to release an updated MRE sometime soon. So in Q4 of this year, which is expected to be bigger given that the 2023 exploration program that included close to 5,000 meters of drilling in 4 holes all came back showing porphyry-style mineralization with grades ranging between 0.26 and even 0.7 at times. Apparently, though, that's not everything because there have been PGEs, so platinum group elements, discovered in the La Plata region as early as the 1930s. And on top of that, some of the alkaline rocks and carbonatite in the region also suggest that there might be rare earth elements potential. And the gold and silver in the region is actually associated primarily with telluride in high-grade epithermal veins. So there's even potential for that. How they are picking between those metals and how the focus is being refined is also something I hope to understand later on in my conversation, as well as, of course, the metallurgy behind it all, because there's many different metals. La Plata is also the project that got Newcrest at the time interested in metallic minerals, and Newcrest has, of course, now been taken over by Newmont. But initially, they had invested $6.3 million at 40 cents per share, so almost double the price that we are at today. Also forming a technical committee in the process, which helps Metallic with its exploration efforts, essentially. And ever since this initial investment in late 2023, Newmont has kept topping up its ownership during financings. So they've not been diluted out of their, as I mentioned earlier, 9.5% ownership, which including, by the way, as most recently this summer, there's a flow-through financing to the tune of $2 million that was, again, completed, I believe, in July of 2024. The different minerals in Colorado is not the only thing that the company has to choose from and strategize around, though, because, as I mentioned, they're also active in the Yukon at 2 different spots. And that's going to get interesting because one of those spots is Keno Silver. That's a silver, lead, zinc, gold project that has a maiden resource on 4 zones on it from February of 2023. Showing over 18 million ounces of silver equivalent, where about half of the whole resource is actually silver. So it is, yes, silver equivalent. About half of that is silver, with again gold, lead, and zinc making up the rest of the mineralization, with the average silver equivalent grades being 223 grams per ton, about 120 of which attributable to actual silver. This project, by the way, is adjacent to Keno Hill, which is now a Hecla mine, with about an 8-year LOM remaining on it. But more importantly, this is Hecla's highest grade silver mine, and soon enough it will be Canada's largest silver producer. Although Keno Silver looks to be a little bit different geologically, so that's hopefully something we can touch upon later on in the conversation. And then last but not least, Metallic is actually expecting some revenues this year, quite untypical for a junior, and they're expecting it from a royalty that they have on a placer mine in the Klondike, which, if you're paying attention, is where the Discovery Channel show Gold Rush is set. And the project Metallic has a royalty on is currently being operated by one of the darlings of that show, with that being Parker Schnabel. There are multiple other things happening at the same time. There are other royalties that the company has in the district, 10 plus royalties, actually, not all in production, of course, but potentially revenue generating stuff once developed. And these, again, these are placer royalties, so they're quite different. They're typically rather high than your 1 or 2% NSR. We're talking about 10 to 15% range royalty. So how much revenue that is actually going to result in, and when or if, remains to be seen, and hopefully something Scott and I can discuss later on. But for us to actually start discussing something, it might be a good idea for me to shut up. So Scott, this is your first time on the CEO BBQ. So obligatory first question here. Who are you, and why should I trust you with my money?
Well, my name is Scott Petzel. I'm president, actually, not CEO. So you're barbecuing the president instead of the CEO. I'm a geologist by training. I grew up in the Midwestern U.S. I have been president of Metallic Minerals since 2021, and was with the company as vice president of exploration since 2016. I've got 36 years in the business, and I've been all over in all kinds of different deposits, and had a very interesting career.
About that, why do I trust you with my money part? One thing that makes it easier for me is if we would be aligned, right? So this is where we talk about skin in the game, and insider ownership is listed at about 14%. How much of that is you personally, and what do you think your average cost of capital is?
That's a really good question. It's not something I've necessarily concerned myself with. I believe in our projects, and I believe in our company, and I believe in our sister companies as well. So I have continued to invest in those and support our activities, and that's why I'm still here and still moving forward with these activities. And I believe, rather than be a market maven and look at all these sort of other statistics, that if you have a good property or a good project, that is intrinsic value. And if you know or have the skill set to be able to push that project forward, like I think we do, in the sense of both myself and our CEO, Greg Johnson, we have the ability to understand or recognize value in underappreciated programs or projects and extract that value through this early stage of exploration, resource addition, and then de-risking through systematic, exploration, but also the economic studies and building a platform or a foundation on these projects to let them really shine. And so when you get into that mindset and you think about these assets and what they represent in their asset class and how to move those forward, and if you have the belief that you can do that based on what you're seeing and based on the deposit itself, the other stuff is superfluous to me. So, I have my ownership. I don't know exactly what it represents at this point in terms of percentage or anything like that, but I know that there is value in this project or these projects and that we are the right people to take them forward.
Is this a significant investment for you, those that's kind of what I want to understand here. Is this your largest personal investment? Do you typically invest in other stuff, or how do you look at this investment?
I have a basket of smaller underappreciated junior companies that I'm interested in, and a lot of those are, sort of Yukon based, but others that I'm familiar with as well. Metallic is my largest shareholding of those junior companies, and it is personally important to me, and will be, of course, if we're successful, something that we should like to see rewarded from our efforts.
Well, Metallic you bring a good point when you say a basket of other juniors, because it reminds me that Metallic Minerals is also part of the Metallic group of companies. Does that mean you guys share personnel with each other, and does that mean you work at some of the other companies too, or is this company your only focus now?
Well, the way we're structured, there is no cross ownership or no umbrella corporation. It's simply a Metallic group of companies, which is acting in a loose collaboration between the three companies, which are Stillwater Critical Minerals and Granite Creek Copper, and ourselves as Metallic Minerals Corporation. And that collaboration really stems from the understanding that we all have the same strategy and approach to how we do business. And that is that skill set of, appreciating these underappreciated assets, acquiring them in low price cycles, doing the systematic exploration, building that project to what we know can be value. And then the exit strategy is similar as well, as find a major to come in and take that thing on, or, make some sort of monetization transaction for those projects so we can go on and do the next one. And so what we do in terms of this collaboration is we often collaborate in that strategy, but also we share resources below the CFO level. So some of our things like marketing campaigns are shared, where we'll get a discount if we do a 3-for-1, those kind of things. And our technical staff, we share amongst the three companies. So everybody below the CFO level is shared. The technical staff, we're actually in this shared arrangement able to have a more higher skill set technical group because of this sharing ability. So for example, as a one-off junior company that's got one property may have a vice president of exploration and a project geologist, and no specialists in that group that are able to kind of absorb, some of the niche geologic or exploration services without having to go externally for higher price contractors. So it really works for us to be able to have this talented pool of geologists and be able to utilize their skill sets on the specific projects that that can benefit from those skill sets, and to move those people around each project as it becomes important to do so.
Are there any royalties that you or other of the team members own personally, or anything that Metallic currently operates on, but you guys own a personal royalty on?
Nothing that any senior member of the metallic team or metallic group has a personal royalty on any of our projects.
There was some money due from related parties in your balance sheet. Where does that come from?
Great question. Might be a better question for our CEO, Greg. Like I said, I pretty much focus on moving the company forward with respect to our technical components and, understanding kind of how we're going to progress these projects strategically to maximize our return from them in the longer term for our shareholders.
And we'll definitely get to that point because there's loads to talk about there. Why I'm asking you about the related party transactions is because I'm thinking whether they're some kind of a service company that's currently delivering services to MMG helicopters, consultancy, market, something else.
Yeah, well, that's specifically. So, there is a company that's owned by the CEO. It's called True Point Exploration, and True Point is the service provider for the three companies. So this talent pool that we have below the CFO level work for True Point, and those services are provided back to the companies.
Yeah, but nothing along the lines of financing, marketing, helicopters, anything creative, so to call it.
Nope.
Well, this concludes what I call my smell test for the barbecue. That's why I start with them. They're always the same questions. They kind of start sporadically, but they're kind of all centered around what's your incentive? How does that align with the company? Let's talk about the operations here for a good long minute. I typically continue by asking what the main unanswered question is for the company. But again, you have multiple projects and they're all active kind of at the same time. What's really the focus here for the company? What is Metallic Minerals?
Well, I think, we're a precious and base metal exploration development company focused on, these assets in North America. And if you would have looked at us in 2020, when Eric Sprott invested, August of 2020, we had a 90-cent share price at that time. Our focus was predominantly our Keno silver lead zinc project in the Yukon. And that's what we were kind of known. We were, being more branded as a silver company. And, as a result of, at that time in 2020, we really were just producing exploration results. We had no resource on any of the projects that we had. We had only just acquired the La Plata project in Colorado, this copper, silver, gold, platinum, palladium project. And, we considered that kind of optionality to the shareholder in terms of, well, we're not quite sure what this is yet or where it's going to go, but we think we recognize some considerable value. So we'll continue to market ourselves as a silver company and do work on the side on this project in Colorado and see where things develop. And as we were able to start that data compilation and grow our understanding of our asset in Colorado, we recognized we really had a tiger by the tail there. And I think what you're seeing now is we're still in the late quarter of transitioning to more of a La Plata project focus and less on the silver side. So you could say we're a multi-metal junior explorer right now with more of a focus on copper, but recognizing that this silver asset in Canada is, as I said, it's a tier one asset, as you mentioned, with regards to being next to Hecla's operation, where they're mining 4 to 5 million ounces a year on what is their highest grade assets and one of the highest grade silver districts in the world. That's still a very important project. But we've got to be sensitive to how we value each of these projects and how we can kind of extract value for the shareholders from both of them, because it's rare in my experience to have a junior that's got two very different, but strong assets in their asset class, plus this royalty revenue that you mentioned earlier as well.
And we're going to get to that royalty revenue as well. But I want to talk about La Plata first here, Scott, because I like porphyries like everybody else on the planet, I suppose. But in your case, the grades you've reported in the currently public MRE are on the lower end of the copper porphyry spectrum. but they've also fluctuated between your drilling in 2022 and 2023. So do you expect the upcoming updated MRE to have higher average grades and higher cutoff grades?
Well, we're still going through those tabulations right now. I know it will be an expansion on the pounds of equivalent copper for the resource, but we're in the final throes of kind of looking at how this is going to come together. And we should be, close to announcing that here in Q4, early Q1 of 2025. But what I think our drilling did in 2023 is it did prove that there are some big broad intervals of this lower grade material. And we had not, sufficiently or adequately defined the vectors to higher grade by that time. We recognized that that higher grade is there and that there is vectors, and we have learned from that drilling what those vectors may be. But at the same time, we're looking at this as more of a district play. So we have a resource, it's 1.3 billion pounds, on the smaller side yet, and on the lighter side of grade, but with high grade potential within it. And you think about the fact that we've only drilled, 26,000 meters on the project to date, that it's really not a lot. But this is a district that we control 2/3 to 3/4 of, that is 10 kilometers by 10 kilometers in scale. And all the drilling that's ever been done on this porphyry district is within a square kilometer of the resource area. So through our work, we've gone out, and particularly this summer, because we did not drill in 2024. This is more of this foundation building exercise that we're going through here, because we recognize what we do have, is we've identified 16 other potential porphyry centers. And the reason I say that is, I know it's maybe a little more technical than we'd like, but it is a porphyry deposit. It's a subtype of porphyry systems called an alkalic porphyry system. And those generally are not the big, massive centers with low-grade copper that are mined by open pit, but they have fingers around multiple episodes of intrusion. And those fingers can be 1 to 500 meters on a side, and there can be multiple ones of those. And the good example of that is Cadia Hill, that and also Red Chris, that Newcrest owned and now Newmont owns. And Galore Creek is another really close analogy to what we're working on here. So multiple centers of mineralization. We've got a limited footprint of drilling in a 10 kilometer by 10 kilometer district that we focused on refining additional drill targets. So we'll have the ability to go in 2025, work on the vectors that we've recognized from the 2023 drilling, and apply those vectors to expanding the resource in the Allard resource area, but also to test new targets as we've generated them here this year with the help of Newmont. So Newmont seconded geologists from the Red Chris mine to come down for half the summer to help us map and understand the system with their expertise on these types of systems. So it's been a very good year, and I think going back to that, yes, a little lighter grade for the overall part of the resource that you see, but that opportunity for high grade is there. The opportunity to expand on vectors to new high grade, plus add new targets, is strong. And then the last thing I'll add on that is, our resource is a copper silver resource. And the resource update that we are doing will be the first edition of platinum and palladium and probably gold too. So that will help on the grade side and in terms of overall value for the project. So I'm excited about that.
You bring up a good point, because there are higher grade intervals within some of that drilling that you had completed previously. Although narrow, though, they were just about a half a meter that you had a hole ending in 11.5% copper equivalent. But again, the entire hole was 816 meters of 0.4%. So could grade concentration and grade variability prove a challenge in defining this ore body to its full potential?
Well, I think, we saw that hole. It started off in a little bit lower grade, and as it went down, in the bottom 500 meters of the hole were over 0.5% copper equivalent. As you mentioned, the high grade at the bottom of the hole, so 30 meters at 1.5%, with increasing grade right to the end of the hole that stopped for mechanical reasons. That this these indications, the right minerals are there, the right alteration package is there, and this is a very small part of a big district. So we know it has a propensity for high grade, and the resource is one thing, but keep in mind, we're still early stage in terms of exploring what we see as a broader district with the ability to both grow this resource on new vectors, but to test new targets. And I do think that with drilling, ongoing drilling, we'll be able to move this thing into a similar size category to, say, Galore Creek, which is 11 billion pounds of copper and 11 or 12 billion ounces of gold and 250 million ounces of silver. So it's there, and it's early enough stage that we're building that understanding so that we can really take advantage of that knowledge to grow the resource and find a vector to the high grade to help solve those issues.
Is your internal thesis that the grades would be picking up at depth, though, and how much deeper do you think you're going to have to drill it?
Yeah, I don't think depth is necessarily a containing factor for us. I think we're seeing surface grades. So I mentioned this project has only had 26,000 meters of drilling, and that includes historically drilling by Rio Tinto and progenitors of Freeport and Rio back in the 50s through the 70s. And their focus, which has set the basis for what the Allard resource is, was really on a limited land package around that specific resource area. So they did not have the ability to go outside their own boundaries and drill these other targets. Whereas in the 50 years since those companies have walked away and no exploration has been done, the district, we've been able to acquire, like I said, 2/3 to 3/4 of the district itself and evaluate the district in whole as opposed to just piecemeal. So when we have the ability, Rio Tinto, Freeport had the ability to raise money and drill the project that they had, which is not the project, not of the scale that we have currently. So as we go out and we evaluate different areas that look geologically prospective, and we've come across targets at, say, Copper Hill, which have 6 to 11% copper being sampled at surface, or Morning Star on the a kilometer to the west, which has 2% copper equivalent at surface with anomalous PGE mineralization right there. And all these different targets that we've evaluated, we see the potential for grade, we see the potential for more tons. So
why did Freeport leave there? Was it size? Is there anything that, well, maybe you don't know, but if you do have that information, why did they back off, and what have you learned from their potential mistakes here?
Yeah, well, I think that there's a couple of different theories, or at least my theory out there is that, again, they had a limited land package in the district. It was very competitive at the time with Rio, Freeport, Exxon. I think there was a company called Hacienda in there, different companies owning the ground, trying to do exploration, but not getting any drilling done. Rio Tinto in the 1950s, the model of exploration was a little bit different, right? You didn't have all these juniors out there in the market trying to fill that niche of making discoveries and going to first resource. You had all the mining companies owning all the exploration projects. So you had, say, a Rio Tinto. This is just an example, but say a Rio Tinto with 4 producing operations making money, and they're saying, well, if we're mining these resources and we're making money, we need to put that money back into exploration to replenish those resources. So let's get an exploration team and we'll start acquiring projects, even at a very early stage. They could be conceptual or generative projects. And so they would have a stable of 30 different projects. And in the 50s through the 70s, there was a bit of a copper rush. I think that's, and again, I'm speaking out of pocket without facts in front of me, but that's really when a lot of these senior companies went and explored, discovered, developed the large open pit porphyry systems. Before that, the model wasn't strong. But the model came together and they began to apply that science and pick out these porphyry systems. So if you're a Rio in 1970 and you have 4 operating mines, 30 different exploration projects, and you're prioritizing each of those projects every year, and you go in and you drill a 0.3 in percent copper grade in southwestern Colorado versus something you just acquired in Chile that's twice the grade, you're going to say, well, maybe we ought to be focusing on this one. And every year they had to go through and prioritize and focus on the projects that made the most sense for them at the time. We'll come around to the late 70s, copper price was low. Rio Tinto or Freeport really focused on the copper and the silver historically and did not sample or appreciate the amount of gold, platinum, palladium, or even tellurium in the system. So I think the fact that they had a lot of competition at the early days of porphyry exploration for other projects to be of higher value, and the fact that they necessarily weren't looking at the system as a whole, plus the fact that they were focused on just copper and silver and not these other precious metals that come into this story, would have been causes to have them say, well, let's not prioritize that one. And Freeport ended up with a few of the claims and held on to those claims until 2002, which was another time in the industry where the copper price wasn't that good.
What would you say realistically are economic grade thresholds, if you will, for mining porphyries in Colorado today? Are there any examples of OPEXs that you can talk to me about?
Well, I think what our goal would be, I think, would be above 0.5%, probably more like 0.75% copper equivalent for a mineable block cave operation. I don't know that it has to be, any more than say 50 million tons, but ideally 100 million tons of 0.75% would be a really good sort of opportunity for us, and something that I think Newmont would want to move forward with. So we already have 147 million tons at 0.4. A smaller, if you raise the cutoff grades, you could have 0.5% or something. But we see that potential to get that, and that's why we're still there. That's the building of geologic knowledge and expertise to say we got to go over here to make that discovery.
Well, I know it's early days, and you'll have definitive results once you get to the economic studies and all that. But metallurgy is going to be a big part of that, of whether that grade works or not. You're dealing with multiple different metals. Talk to me about the metallurgical work that you've done so far and the recovery rates. Recovery rates of what you might hope to get for copper.
Yeah, well, I think one of the things is, in our resource, we're using assumed average industry-wide recovery rates for these types of deposits. And we have not personally done any metallurgical work to determine specific recoveries. And the reason we have not yet done that is, again, we've got more resource building to do, but also that the mineralogies that we're seeing in the drill core and the rocks are fairly simple. That the copper, the silver, the gold, platinum, and palladium are all tied up in the basic chalcopyrite and bornite mineralization that you typically see in these types of deposits. The platinum and palladium is looking like it's a coating on the bornites, and so we're still doing some sort of petrological work to understand, or mineralogical work to understand the distribution of some of the platinum, palladium, and other minerals in the deposit, but it all looks fairly simple from a metallurgical standpoint. And as the resource grows, we'll begin to employ more metallurgical testing on those rocks.
When do you think you're gonna know more about that, more specifically in the future?
Well, I think I think that's a good question. I think as we continue to do exploration, there just becomes that tipping point where people like yourself want to know, is this thing actually metallurgically viable? And we'll begin to incorporate those tests and move towards economic studies. But right now we're not focused on economic studies, we're focused on resource building. And that will help dictate again, as you get something. We talked about, say, a goal of 100 million tons of 0.75. I want to have some assurance that we can mine it, and process these ores and understand the metallurgy of that. But I want to focus. I don't want to spend that money too early. I want to focus that work on the deposit that we do believe is going to be viable going forward. And I'm not saying that Allard won't be, but it has to grow, and we think it can grow. But we also think we're going to be able to find other deposits. So it might be a little early to do a little bit of metallurgical testing until we're growing this resource out to something that we see would be, completely viable.
Well, why I care about this, Scott, or why I asked you about it is because the platinum and palladium grades are rather low, right? Do you think those would be deemed credits, or would it cost you more to separate the copper from them than their value per ton of ore?
That's a really good question. I think the way, if it is indeed as coatings in the chalcopyrite, it's going to end up in the in the concentrates and move down the line that way. So it is a bit early to answer that question, but I think right now the amounts of platinum and palladium that you're seeing are small. But if you look at an example, Bingham Canyon in Utah, they're beginning to recover platinum grade from their system, and that is grades of, say, I just lost the figure, but what we're seeing in drill core is the grade of what their concentrates are. So this is a pretty high for a porphyry system. These are pretty high grades for platinum and palladium, and there are porphyry systems that are starting to see revenue generated from byproduct platinum palladium. And so that's the thesis we're working with, the details of which I don't have for you right now, but that's the direction we're going.
Do you have to do more drilling before you have that answer, or is it mostly just doing studies from here on out?
Well, I think we could concentrate on that if we felt it was necessary at this time. But I think, again, more data, more resource, greater understanding. There becomes a time in the process where it's like, okay, we really need to know this now. This is the next step, and it's really part of that beginning to engage in preliminary economic analysis, because it's necessary for that understanding. Right now, it's not necessarily necessary for us to understand that as we see this potential for the resource to really grow, and that's the focus. We know that right now 1.3 billion pounds of copper at 0.41 is a nice chunk, a great start, but that it can be bigger and that we can identify more high grade to accompany that. And that's the focus. If we do that over the next 2 or 3 years, at some point in that process, we can start to initiate metallurgical studies, start to focus on economic studies as well. But right now, the focus is really just build that resource to as big as we can get it.
How much is a meter of drilling costing you, by the way, up there in Colorado?
Yeah, I think if you look at just direct drilling costs, it's actually pretty cheap. We utilized an Eastern Canada driller this year, and on a US dollar basis, we were around 275 for direct drilling. But if you take the all in, I don't have the number directly in front of me, but I think it's almost acceptable to look at this as an industry-wide standard these days. Is a lot of times when you start looking at exploration expenditures, and you did a great job of breaking them down through the financials. But what goes to my head is that by the time you've done the regulatory, you've done early stage geophysics and mapping and all that sort of stuff, and you throw all that in, at this stage, it's about $1,000 a meter to drill exploration holes. And I think that's pretty typical. Other companies may not sell it to you that way, but I think it's pretty typical across the industry, unless you're doing a different type of drilling, RC drilling on a grid with a bigger is better kind of approach. But certainly in these smaller, more focused programs, it can be as much as 1,000 all in for running an exploration program on a per meter basis.
Why I ask you this is because I'm basically trying to figure out how much money you're going to have to spend before you've essentially liberated the potential for what you call a district scale porphyry here. And again, listening to your answers, it doesn't seem like it's going to be cheap. So are you considering taking on a JV partner to help you finance some of that work? Are there other ways of financing this thing outside of just traditional equity raises?
Well, I think there are, and we're always evaluating different ways and trying to, really protect the shareholder in this. Is we don't want to give away the farm before we've extracted the value that we see in the project. And that's challenging in these markets, right? When your share price was 90 cents and you've added to resources and you've generated revenue, now your share price is 25 cents. It's like, well, there's no appreciation for any of the work that's been done, and it's really significant foundational additive work. So how do you go about kind of getting to that next stage? And I would say in some respects with La Plata, we could see $50 million worth of investment in the next 3 years to get us to an economic study that would be the carrot for a Newmont or some other company to move in. And spend 10 million next year, 20 million the year after, 20 million the year after, and have 50,000 plus meters of drilling done to build that resource out to 3 to 7 or 8 billion pounds of copper. Then the question comes back to your question: where do you get that money? And how do you do it without overly diluting your shareholders at 25 cents? So that's a bit of a challenge. I think we have optionality in our company. The one thing that I think is noteworthy is that we've got Newmont at 9.5%, and as you mentioned, they have topped up twice in the last year to maintain that 9.5%. We're seeing a lot of input from Newmont on the technical side. We have access to their chief geophysicist and their geologic team, and as I think I mentioned, they seconded geologists to the project this year from their Red Chris operation to help map and do targeting at their cost, and that it's been very beneficial. So we have, if we just look back at the Newmont deal that started with Newcrest, we have warrants built in. They're good for 3 years. Those warrants are at 55 cents. I would say it was implied initially that those warrants were going to be exercised at the end of 2023 to support the drill program in 2024. But because the share price went to 20 cents, No one was going to exercise warrants at 55 cents. So the conversation kind of continued, and there's some interest in perhaps participating or leading a private placement with Newmont to get the next level of exploration done. But when we talk about the $50 million need, there is room, since Newmont's only at 9.5%, to bring in another large investor or large company. Joint venture is possible, but not likely the best path for us financially or for our shareholders at this point in time, because there are some trips and traps in that game. But the other way could be through the monetization of the Keno Silver project at some point, to help, again, defray dilution to our shareholders as we focus on the La Plata project and build that out.
Why isn't Newmont a likely joint venture partner, though? I mean, if they like the project as much as to get a 9.5% ownership, they've done it before. There's one of my personal biggest holdings has gotten a direct investment from Newmont as well as a joint venture deal. So why is that not likely?
Well, I'm a Newmont holder as well, and I think is it likely? Maybe have to ask them. I think that if the terms and the agreement and the value for our shareholders makes sense, then we're going to be open to that opportunity. But from the idea of deal tension, sometimes you want to build deal tension, and maybe if you've got a world-class asset like the La Plata project, or like what we envision the La Plata project to be, perhaps having someone else in there in a competitive sense to help drive value could be of value to our shareholders. And so, I'm not saying that it couldn't be a joint venture with Newmont. I'm not saying that it has to be somebody else. I'm just saying that there is optionality in the ways that we can approach this. And we're, continuing to look at all those different scenarios to see what makes most sense for the shareholder.
How's permitting in Colorado? I don't think I've so you're in the US. Is this BLM land? Is it Forest Service?
Yeah, it's 10% privately owned land that we own, metallic minerals, and then 90% is on Forest Service land. And so, we're subject to the NEPA process going forward. And, I think the one nice thing about it is there is clarity there. We kind of understand what the NEPA process represents and the steps that we need to take. And we're continuing to kind of work with the Forest Service, but also work on that social acceptance side for the things that we're planning to do in the next couple of years. And in fact, next week I'll be in Colorado for a series of open houses that we have in the communities surrounding the La Plata Mountains, just to inform them of where we're at, what we're doing, and what we're planning. And so that whole process, building relationships locally, building relationships on the regulatory side, being transparent with our plans and activities, and moving the project forward that way is foundational to our ability to have success going forward. So we put a lot of effort into that this year, and in lieu of drilling, but also in addition to the target generation work we've done geologically.
Do you need anyone to sign off on any documents to do? And I'm throwing out a wide net here to capture everything, but do you need anyone to sign off on any documents in order for you to actually go back to exploration on the project, or do you have everything you need?
We have a couple of areas that we're able to have permitted and are able to initiate drilling on in 2025, but we're trying to expand that with some of the new target generation that we've done. And so those are ongoing discussions, and it's just, again, going through that process with the Forest Service to get, what's known as a categorical exclusion to drill a certain area, and then socializing that along the way with the communities.
And that's happening now, essentially. When do you want to go back to Keno Silver, though? You mentioned that there's a potential monetization event. What's kind of the chronology, if you will, between now and you going back to Keno Silver?
Well, we raised 2 million, as you mentioned, I think in July of this year. That was flow through funding. That money was specifically earmarked to do exploration in Canada. So applied to our Keno Silver project. And we went out and we drilled a very small program on the project this year to help extend our resource at our Formo target, and also test a new target. And we should have results from that drilling sometime this fall, and again, releasing those to the public either in Q4 or Q1 of 2025. And so we have done some exploration. We're awaiting those results, and we are looking forward to kind of getting back out on the project in 2025 and continuing exploration.
Right.
To, essentially, I mean, we're strong believers in the project, but we have that sense that our shareholders want us to focus on that thing that can bring the most value to them. And I think that is La Plata. And so we'll continue to kind of balance and see how things play out, but also just look at all the different options for not only monetization of the project, but if that doesn't happen, how we can maximize our exploration efforts there to grow that resource.
But preferably, I mean, what's the goal here? Do you want to expand the resource there too, or do you think a buyout before that is more reasonable?
I think it's possible, and I think for us maybe preferable. But again, I can't presume anything in the sense of a buyout until there's an agreement or further discussion on the table with that regard. But there has been expressions of interest, and so we'll pursue those. And if the deal's right, perhaps we make the deal. If it's not, then the next course of action is to continue to build resource so that it has the weight, the gravitas, where it can't be ignored. And I think the thing that I think about with respect to the Keno Silver project, and you mentioned you wanted to kind of ask about the geology as you're seeing some different things in there. I'll first start out by saying, it's a small inaugural resource that we put out. It's almost 20 million ounces, 18.2 million ounces. And, that may not seem particularly impressive when you think about a Dolly Varden or a Vizsla or, some of these other companies out there working on silver resources. But this is the highest grade district in Canada. It's one of the highest grade districts in the world. And we're right next to Hecla, who's producing 4 to 5 million ounces a year. We have put this 18 million ounce resource together with 18,000 meters of our own drilling. So for every meter of drilling we're finding 1,000 ounces of silver. We've done that for roughly $18 million worth of expenditures. So for every dollar we're spending, we're finding an ounce of silver. And, silver at $30, I'd say that's pretty successful. It's taken a few years to get there, and that's because we have really focused in these past years on target generation and doing geophysics and geochemistry and soil sampling and mapping and, LiDAR surveys. And those are all extraneous costs. Those are not drilling costs. Those are extraneous, but they add to the story of discovery and help us target the work that we're doing to make additional discoveries. So when you look at the fact that we're, even with the drilling that we've done, 26,000 meters or 18,000 meters that we've done, plus the 8,000 that's done historically on our property, that type of a drill program could be done in one season, and that we've been able to add 1,000 ounces per meter. So we could get, to my mind, if we spent, if you use that metric I threw out earlier, $1,000 a meter all-in costs. And if you're finding an ounce of silver, if you spend $25 million, then you could probably add another 25 million ounces to that resource and do it in a season or 2 seasons. So the value is there. We know, with all the work that we've done over the last 8 years, we've really learned to target where the best targets are going to be. And we've been able to make discoveries in that process too. So you'll note that some of the areas in the resource, which is combined of 4 different target areas, that those are of a little lower grade. And that's indicative of essentially the same geology. I know you wanted to ask this question, so I guess I'm jumping forward, Antonio, but it's indicative of the same geology. The district is 35 kilometers across. The geology that you see on the west end is essentially the same as the geology you see on the east end. And the east side of the property, which is more mountainous, a little more vegetative covered, is largely our land holding, except for a few internal blocks in the Hecla ground. And we've been able to go out there with that early stage exploration work and kind of have a look at the various targets. We've identified 40 different targets, and some of these would have been able to make that sort of first drill discovery on. So of the 40, we've drilled 10 targets. We've got 4 of those to resource. In one of those or a couple of those targets, they're all very shallow. So we've not really drilled any holes and identified mineralization much deeper than 250 meters. Hecla's over here drilling 600 or 800 meter holes underneath Birmingham and their productive deposits to add new resources. Ours are very shallow. And in fact, we at the Fox target identified what we think is, potentially open pitable type intervals. And that's because the mineralization, which is the same mineralization, it's silver, lead, zinc veins, but these are sheeted veins instead of massive veins. And the sheeted veins extend over 170 meters in drilling and dip at 15 degrees shallowly. So the configuration is really there for those to be potential open pit deposits with, a tenth of the cost of an underground mine. So you can take a tenth of the grade and still have it be profitable. And that's kind of what we see with Fox and some of these other targets at Homestake and Caribou, is that they're shallow dipping at surface and may have the ability to support open pit mines as opposed to being specifically deep high grade underground. But it's the same geology, it's just different morphology, if you will.
How's the project from a First Nations perspective? Do you have agreements in place? Because if someone was to appreciate what you're just saying here about the geology and wants to take it off your hands, they'd probably want to look at that too.
Yeah, we don't have any active agreements with Nacho Dun, which is the First Nation that we're working in terms of their ancestral lands. And but we do have good communication with them and have supported them in the past on various efforts for land use planning in the Yukon. And so, no, that'd be something that I think would have to be worked on as the project developed, move to more of a mining stage. But again, we're really focused on just resource addition there if we're going to continue to hold the project and move it forward.
And then on to Klondike, I suppose you're expecting some revenues from Parker this year. How much will that be?
Well, it's actually going to be reduced. We'll have a specific update on our alluvials here coming out as a public disclosure or news release soon. So I don't want to get into the specifics of that too much, but I think what we're seeing is a bit of a reduced royalty revenue in 2024, but a better setup for 2025 where we should be able to have two different operations and to be able to see those produce over a season. Because, when Parker was there, I don't have all the statistics from 2024, but when Parker was there in 2023, he produced around 1,300 ounces in 21 days of mining in what was considered a startup season. And so there's some challenges in 2024, but that should radically grow as we get into a 100 or 150-day mining season and multiple operations in 2025. So we're excited about that. And again, we'll have some more news on that forthcoming.
What's your overall goal with these royalties, though, Scott? Because do you plan to keep them, spin them out, sell them, something else?
Well, I think one of the things is we're the third largest holder of alluvial or placer ground in the Yukon in total. And one of the things, as part of the co-founding team of NovaGold back in the year 2000, of course, NovaGold had great success. Our CEO, Greg Johnson, and I were both part of that team that grew NovaGold. And we went from 25 cents to over $20 in 10 years on 3 big projects. The one thing that really made us successful is we had a gravel sales business in Nome, Alaska. And the profits from that really helped us through the bad times in the markets in those days and kept the company afloat, kept us on our feet. And that's essentially the same thing that we see as a possibility here. So beginning to have revenue stream from these operations is helpful in a couple of ways. One, if we're built out the way, if you just look at Parker's revenue, if you mine 1,300 ounces in 21 days, we took 10 to 15% on that, depending on what part of the pit he was mining in. You can look at those numbers and see what that revenue stream is. If that were a full season and you took 20 days and multiplied it times 5 to get to 100, what does that look like? Well, that amount with just one full season qualified large-scale operator pays for all of the expenses related to running the company. Okay, so that is one aspect. Is if the market were to continue to be down and we were unable to raise capital that was dilutive, we still had the ability to run the company on royalty income as this grows out. The other part of that is, as third largest claim holder or mineral rights holder for alluvial ground in the historic Klondike district, we have the ability to continue to add operators as we get more sections of this ground permitted. So we could have as many as 10 operators, and I haven't done all the math, but we could have as many as 10 operators producing between 200 to 2,000 ounces for each operator, or even up to 5,000 if it's a big sort of Parker-sized operator, and receiving that 10 to 15% royalty on all that production. And that is significant. That's almost a good positive business in itself. But those funds, as they cover the corporate costs, could also or would also supplement exploration and reduce dilution to our shareholders.
I was going through my notes here and think that's a very interesting strategy that you're going for, Scott. There's something that I would like to talk about more in depth on, but also looking at the clock, we've been at this for more than an hour, so I don't want to lose all of your time today. What else? We talked about Colorado, we talked about the Yukon, we talked about the royalties. What else? What am I forgetting to ask you? What did you come here hoping to talk about that I failed to bring up?
Well, again, we haven't talked about like any recent drill results or anything like that. What we had was a year where budgets were tight. And I think our share price has suffered from that lack of immediacy in terms of results. And we've had some pressure on the share price from, some large individual holders of late. But the assets are still the assets, and we are still building what I would call foundational or formative processes in the building of value for our shareholders through all those things I mentioned: the regulatory side, the social side, the technical side, in an effort to grow these resources to where they can't be ignored. And they're all three unique in their way, but I think that also makes us unique in that we have a significant amount of optionality right now in terms of how we focus and prioritize and how we monetize and build value for the shareholders. And I think, you're in the game here, so there's maybe no better time right now in the market to be looking at companies like ours, because the venture index is as low as it's been since 2011, and gold price is up significantly in that time period. So there's a lot of catch up to be done at the junior level. And if you have a company with good assets like ours, then maybe that's the right place to grow those assets.
You bring up a point though. Is it a good time to get involved right now when we're going into tax loss selling season here? You're down over recent weeks. It's improved actually, because you were trading at around 18, 19 cents not too long ago, a couple of weeks really. But you're still down on the year. If you look at the high that I mentioned 52 weeks ago was about 40 cents. Is there a way for you to deal with that, or is just kind of sit it out and see what happens? I mean, if there's a lot of stock coming into the market, is management capable and willing to mop that up, essentially, be there in the open market buying up shares?
Yeah, I mean, we'll see. I mean, I think, we do have some news flow coming, obviously, with the resource update on La Plata and drill results for Keno, and perhaps, news flow on the alluvial side that I mentioned. And those things could be additive to the story. And then the next layer is that how do we begin to kind of move these things forward with low cash? And like I said, there's a lot of optionality. There's different ways that we can approach it. So that could be another layer of news that could be forthcoming in the next few months. But I think, in terms of market conditions, you think about where we're at today, and yeah, there's going to be tax loss selling at the end of the season. But if you look at all those, like the GDXJ, the GDX, and the price of gold, there are really some significant fundamental changes happening in the market. So when is the right time to price the market? I would say try not to niggle that at all, and just get yourself in with a company that has assets that have some strength. And we're fortunate to have that interest of the majors to help, or at least on the Newmont side with La Plata, to help show that our property has value. So the other thing that's going to maybe be a trigger is the election, which is less than a week away here. And I'm sure a lot of people are waiting and wondering what's going to happen with the results of the election and how that's going to affect the market.
Yeah.
But yeah, I talk a lot. Sorry.
No, it's I appreciate the in-depth overview, and there's not much that can be done. I've started asking this question off of everyone at the end, or companies who have seen their stock go down over the last 52 weeks. That's why I'm asking you that question here, Scott. But yeah, I think I've been through most of it. Thank you so much for investing your time. Hopefully we can do this again in the future, and hopefully once you have that updated MRE late Q4 or early Q1 next year, we can have another chat. But thank you so much for talking to me today.
Appreciate it very much, Antonio, and yeah, look forward to talking again soon.